Let's see, get this part started. All right. 2 days before Thanksgiving, as they call it, murder giving, right? Let's keep 100. Do enjoy your families, though. Again, don't necessarily mean I have to agree with the holiday itself. Power and profit to the family. What's going on, guys? Uncle Jocelyn Nev. Salute, salutations, everything that's endearing to your perspective of prosperity, positivity, and profit. Again, we are financial literacy warriors. We are financial literacy vanguard. We are the future. Warren Buffett's, Paul Tudor Jones, Jesse Livermore, whoever your favorite trader is or whatever, or financial, advisor, whomever, you are it. So again, take, own that, bear that power and go out there and further educate yourself to be solid well into your age and wisdom value. And then again, go pay it forward. Go pay it forward to your peers, your children. I mean, just, random people, whatever. People need to understand how to utilize financial literacy as an advantage, right? And so again, I'm happy to be before you guys as always. Again, coming on here in the midday hour a little bit to kind of, share a little bit of the day. Got some things to still do. I'm pretty sure you guys are busy as well. Some of you guys probably are trading. Some of you guys are probably enjoying your families if you're already off for the holiday value, or some of you guys may still be on the job, just that and the third, whatever you're doing. Again, I send positive vibes and good energy to you all. Thank you guys for stopping by, hanging out with your brother African Emporium. As I always say, on Ubuntu, I am because we are. I stand beside you guys, not in front, not in back. We're doing this thing together. All right, very family-oriented, build that we have over here on this platform. So again, dignity, integrity, and respect is what we deal with, because again, we're utilizing the market. And the worst thing you could do is have a mind full of foolishness when you're trying to trade the market, right? So again, we want to be level-headed. We want to be sharp. We want to make sure we have our financial prowess on fleek, as they call it, or on 10 or 100, whatever they say, young folk. So we can always, get after this market respectfully. So again, power and profit to you all. See a few family already popped up in the room here. I see Oba Gordon in the house. Hey, good to see you, Oba, as always. Power and profit. I see the Queen CB in the house. Thank you for stopping by today, Eva. As always welcome to have you here. Power and profit to you, sis. All right, I see my family, Delham Muhammad in the house. Thank you for stopping by today, family. Power and profit to you. Salute. All right, I see my family, Chose Rod in the house. Thank you for stopping by. You say any cap if you could email. Any chance, I'm guessing. Yeah, in your any cap in your email, African. Oh no, it's just basically the same way my YouTube channel. It's just my YouTube channel name, my business name, African Emporium at gmail.com, family. Chose Rod. All right, just African Emporium at gmail.com. All right. So it's very, very easy to be able to contact me. Also, I have a Facebook business page. You can always look me up on the African Emporium, my business page. If you have questions or emails, my number's there too as well. So I am reachable. I am reachable. All right. So again, no worries. So what's going on, family? JL Turn. Good to see you. Over power and profit to you, family. It's always good to see you and have you in the building. Power and profit to you. Hope you guys again utilizing this day to benefit from it. We all know it's self-explanatory by looking at the at my description box, basically what we're dealing with. I'm pretty sure you don't need me to tell you that, but the market is still getting wrecked today. And it's to the point where we kind of expected this to happen. I was already expecting this to happen, so I'm not surprised by it. And again, if you are a student of the game, so to speak, quote unquote, you will be understanding that these are the values of pullbacks that we were obviously needing to have anyway, right? The market needs to be able to correct itself a little bit before it can potentially get new buyers, wash out all this old the old holders, and get some new new blood back into the market, some new buyers back into the market. So this is healthy, right? A lot of people can't fathom that because they don't understand the ebb and flows of how a market works, right? There's buyers, there's sellers. And sometimes when the market gets too expensive or too inflated or too much irrational exuberance is happening, Well, there has to be a moment of correction. There needs to be someone come in and say, well, hey, this is just a little too much. You done priced out, the people that, can't afford these prices, so to speak, in a lot of ways. You kind of overly inflating two things too much. You over taxation here a little bit, right? I'm just putting it in a layman term, so to speak, right? So again, it chokes a lot of your, potential income or revenue streams coming in because you priced yourself out of your demographic, so to speak. And the market kind of did that in so many ways, even though we know a little more to that. But I'm just trying to put it in layman terms a little bit for some of the people that may be a little new to investing or trading, so we can kind of get an understanding of that. Again, it's like you've been going to your favorite Italian restaurant for 10 years. On the 11th year, you go there on your anniversary or whatever, you find out then all the prices that went up, 2 or 3 extra bucks, $5. Let's say $5. Let's make it astronomical because again, we understand how this market, is. It could be 5, 10, 20 bucks. You're like, man, I was paying this, $12, $13 for this dish, literally just last year. Now it's up to $21, $22, right? You're gonna have a problem with that, right? And so in that moment, again, there's a conflict of a buyer seller scenario at that moment, and at that point, we have to kind of meet in the middle, right? We have to come, bring it back down to what the industry standard is, so to speak, or at least meet somewhere near the middle of that industry standard. And right now, the market's kind of out of the industry standard a little bit. It's even though it's retracting a little bit, coming back down to some, back to earth a little bit because it kind of got lost up there in gravity. But these are good, opportunities where the market has to reset itself going into the last, quarter of the fiscal year here. And, beyond that, these companies that had these, exorbitant high, profitable earnings like out of the Q1, Q2 session, 2017, we know was an unbelievable bull market. Everybody was just making money hand over fist. 401ks were popping, TSPs were popping, Roth IRAs were popping, mutual funds were popping. Everybody was making money and smiling, right? But then when you think about it from that perspective, when you have that much euphoria or that much scenarios like of things like that happening, at some point, there's going to be a day where, okay, we're going to have our rainy day. The rainy days are coming. Nothing just continuously goes up like that. And that's when you need to start being start preparing ahead of time, right? So you could be, privy to know when that sign is there or that signal is there or that symbol is there. And you make sure you follow it and make the right decision that's going to be good for you, retaining your capital and protecting your long-term investments, right? Restructuring your portfolio, whatever you're doing, just make sure that you understand the different sectors out there, who's overly leveraged, who's under leveraged, who's an emerging market, all these different factors that we kind of, that get lost in the sauce sometimes because we're not necessarily thinking about them as a whole. We're just taking trades. We're looking for setups. It shows me the setup. It looks good. I'm going to take the trade. There's nothing wrong with that either. Again, if you're making money, again, if it's not broke, don't try to fix it. But realize your game and your aim is to become better, at this. You want to be very, astute and sharp and witty and intuitive. And, you want to have what they call that investor's wit, right? To know how to keep, a post, contact with the market, so to speak, or ear to the ground, so to speak, one eye on the back of your head to make sure you kind of keep your peripheral, protected. And so you don't have moments where you're kind of blindsided by a market like we're dealing with today. So a lot of stocks selling off. It's been happening a little bit ever since the last couple of weeks or so, 2 or 3 weeks ago. No big deal at this point. Ever since Dow hit all-time high, we've been having to deal with some values of the market kind of pulling back. Now of late, it's been a little bit more it's been steamrolling a little bit more to the downside of late, only because again we're going into a holiday season. We had a big sector, obviously in terms of the retail sector, that really got crushed lately. Even with numbers that came in somewhat slightly beating their industry standard or coming in nearly in line, they were getting punished, right? There's no way you can kind of squeak by this market. It's obviously overly leveraged, a lot of premium value in it, and you won't be able to, or you will be able to, excuse me, in your mind, continue to get new buyers to come in and buy these stocks at these high exorbitant prices. Again, these premium-based prices. So because of that, people say, you know what, I'm going to take some profit here. Even though you guys beat on earnings, that's nice. Your Q4 guidance don't seem to be necessarily that much, exciting. You kind of coming in right in line or maybe a little bit over plus minus ratio. So right now, I think it's a good time for me to take some profit off the table. Let me lock in some of this money to pay for these holidays that's coming down the gauntlet here. Again, Halloween, Thanksgiving, right into Christmas, then right into New Year, right? Four moments where they're purging your pocketbook, so to speak, right? Those are 4 significant events that are going to purge your pocketbook if you celebrate that stuff. And again, if you're already doing that, and then you're not necessarily taking profit off some of these old, high price stocks that have made you some money at this point. You're up 10, 15, 20, 30%, whatever. Then you find out that, okay, well, all that, when that opportunity will present itself, so you can take a little bit more, a premium off the top, you may lose a little bit down the back end of the fiscal, the Q4, right? On the Q4 earning value, right? Because people are starting to restructure and get ready to go into the following year. So they're doing a lot of M&A, mergers and acquisitions. They're doing a lot of marketing advertisement. They're revamping old stuff to bring in the new stuff. So everybody kind of got in a little bit lower because they're not doing this a whole lot of boosting their inventory for, or boosting their product value, right? For, new buyers to come in and still try to buy this stuff at these high prices. Again, that's just my assessment, So again, everything I say is my opinion. I always put out my disclaimer, which is down in the description box. I'm not a financial advisor, just that the third. I'm just offering my opinion, right? I'm just offering my opinion. Hey, thank you, family. I see my family starting to come in. Tiarka, did I say that right? What's going on, family? I think I said Tiarka. I think I said it right. What's going on, family? Power profit to you. All right, good to have you in the house, family. All right, I see Over Chris in the house. Good to see you always. Lions of Wall Street. Let's go, family. Salute to you, Over. Good to have you in the building, right? You've been on fire lately too. I've been loving it, right? Utilizing that, the skills, you trusting the process, understand it's a marathon, not a sprint, and you've been, it's been paying off for you lately, right? You've been profitable day over day. That's what I'm talking about. That's the kind of stuff I get excited about. Being disciplined, right? Understanding the power of due diligence, taking it serious to the degree where you know that you won't be denied your bag in this market. Again, $5.7 trillion moved around the world daily. Global transactions. How much are you getting? How much of that are you getting? Like that little Capital One commercial, what's in your wallet? I'm going to ask you guys, what's in your P&L statement? Right? What's in your P&L statement? Right? Subscribe to the Due Diligence MasterCard. The Due Diligence MasterCard. Do your homework. Be serious about your opportunity. Again, there's nothing like this on the planet that gives us such a, a plethora of different avenues and even different asset class that we can obviously engage and trade in, buy equity stake value in to reap a benefit off of. And it cannot discriminate against you. Doesn't care who you are, where you are, what you do, what you don't do, this, that, and the third. All this stuff matters not. And you get a chance to access the same stuff that is privy to, again, these big name people like a Warren Buffett or Charlie Munger or whomever. So again, I know I've said these things many, many times, but I want you guys to really see, the severity of it, how wonderful and how a privilege it is, so to speak, even though it's our money anyway, because you're feeding these global markets through your taxation. They tax you, government tax you, funds into these little companies, they benefit from it because your money going to the bank turn around, loan the money to the business owner, the business owner go out there and grows the business. He goes out there and starts supplying this product, locally, then it becomes, statewide, then it becomes countrywide, then it goes international. And now these other companies are competing because they want to be a part of that same industry or sector, whatever the case. And now they go back to kind of raising taxes or trying to mimic that product or whatever the case. You just feeding it. You feeding it either way, one way you look at it. And then you go to work for somebody else. Now you punching that clock to kind of keep building products. Again, y'all see what's happening here. It's a conveyor belt. Now you step back and you say, well, how can I kind of bypass all this rigmarole and get to the bag, from a beeline perspective? How can I, bypass the middleman, so to speak, and all this red tape and discrimination, and I don't have enough education, this, that, all this other stuff that they require you to kind of be a part of the economic fold, right, to support the system. How can I bypass that and go straight to the bag? Well, guess what? Because you can become what? We trade. Basically, you can start investing in the market. You can start trading these assets. Again, open up a brokerage account fast. You can open up a bank account. So again, ain't nothing new about about this under the sun. Just that people don't understand the gravity of it, or they're not so-called quote unquote educated about the opportunity that it possesses. Right. So again, you guys have been in these rooms, and again, you see people getting to the bag, and you see that, and it's not necessarily struggling to do it. I mean, you're just reading data. All we do is read data day in and day out. We assess information. We apply it back to a chart setup. We understand the value of what the candles mean, what the indicators mean, what the oscillators mean. Then we just go say, hey, what's the pattern looking like? What's the trend looking like? What's the geopolitical news looking like? What's the investor sentiment hitting like for today? And then we go, execute, so to speak. So I know it's more to that, but again, in layman terms, that's based all of this, and we do it already again through our own little various ways when we're, you know, in our free time, assessing something that we like, spending our time to learning something or doing the research because we have a fixation for this particular, you know, whatever. You know, so you're doing it anyway. You're getting caught up in data, you're getting caught up in stats, you're getting caught up in, you know, money flow values, your inflow, outflow, whatever. You understand a little basis of it already before you can get the more intricate details about investing or trading. But I will say this here: if you're not invested, or if you're not necessarily trading the global financial markets, then you need to be invested in something. You need to find other ways to get you some supplemental income, right? And investing in trading may not be for a person that don't want to, you know, devote that kind of time. And it's not really like a whole lot. It really isn't. I mean, you got a smartphone. Your smartphone pretty much gives you a blueprint or a gateway right into all this knowledge, literally for free. Well, you pay your bill, but you get my point, right? You can go get all this stuff literally for free. You know, so again, you need to start realizing the power and strength that you have as an investor, as a trader, as someone who's excited about growth and opportunity, as someone who may say, you know what, my parents ain't never, you know, sit me down and teach me this kind of stuff, right? Or no one in my family really came to me and tried to bring this stuff to my attention. I might have heard people speaking about it, but no one really brought that knowledge, you know, full circle, right? Here's my time to take it to the next level. You got to see yourself doing this 20, 30 years from now. 40, 50 years from now for some of you guys, 60 years for some of you guys. Some of you guys, again, super young, you know, rocking and rolling for to be millionaires before you know it, or 100,000aires or whatever, right? So again, that's what's exciting about this. You got to see yourself being, and the greatest thing about it, once you learn it in a way where you got to understand the basics, you only get better. And it doesn't require you have to go back and get a recertification, you know, all this, that, and the third. So you got to keep up with the, you know, the current situation of what the geopolitical world looking like. In terms of e-commerce, you know, consumer staples, bank finances, all this stuff, it's all tied into one another. You know, so again, by that very understanding, this is why, you know, this stuff is no-brainer to me. And it only burns you because you are not prepared. And that's where people get frustrated, because if you're not prepared and you're just gambling or you're just making choices, you throwing a dart at the board like the little, you know, the monkey theorem that they have, you know, they're throwing darts at stocks and you know, all of them went up. Again, that's long-term time horizon investing. That's different. That's value investing. That's different. But as a investor, as a trader, well, you realizing that your goal is to utilize or capture a moment in time based upon the current condition of the market for in an intraday perspective, meaning what's popping today, what's moving out there today, you know, and what, you know, what was it doing the day before? What was it doing a month before this, you know? All those different things, any kind of particular news that happened surrounding this asset today, right? So again, we just capitalizing, excuse me, on that kind of intraday perspective, right? Even if you swing the straight into the next day, whatever, you still understand that there's some parameters that kind of give you the go ahead to say, well, I feel comfortable in taking this trade into another day or two. You know, so again, it's exciting. It's exciting. I mean, every day is like, man, I can't wait to see what's going to happen today. What's going to happen today? You know, can I find myself in a 20%, you know, move day, or 7% move day, or even 100% move day? Or if you're trading options, you know, a 500% move, 300% move, 1,000% move. Again, I got to, you know, again, I'm fortunate and humble. I got a 800% runner today, 800% move in an options play. You know, trading some of the earning plays that, you know, y'all know I love trading earning plays. They ain't no secret. They call me the earnings killer. Again, you know, whatever. I enjoy it though. I enjoy doing the homework and, you know, and putting myself in a position to see if I'm right. You know, I love doing that due diligence value, or putting in that due diligence to kind of, you know, see if I can be right. And so again, been successful over lately, you know, getting after these assets, you know, and then kind of making the right calls. Been making the right calls. Right, so I'm excited for that. Hey, what's going on? So you got some new family coming in. I barely can see over here. What's going on, family? Doggo, good to see you, family. Power and Property, salute. One of my brothers over in the We Trade HQ family. We getting it in, right? We just had our first session. I'm excited, man. We just had our first mentoring session this past Sunday. To me, I think we had a great time. It's only going to get better. That's what's great about it. You know, we're going to keep building. We're going to keep dropping knowledge. We're going to keep dropping jewels, nuggets, expounding, sharpening our mental, you know, mental faculty, so we can get after this market respectfully, right? So power profit to you, brother. Good to see you. I see my over Jonathan in the house, my brother John in the house, right? My brother from another mother, even though I claim his mother too, because she's awesome, right? My college roommate, my battle mate, my brother Jonathan in the house. Good to see you over. Hope everything going well in your neck of the woods today. I see the Eva Camille in the house, the world-renowned drummer Eva Camille in the house. Good to see you. Right? You guys want to get some, what they call a mainstream artist. I like to call it that. You got a live musician, a drummer, I should say, in the house, and Camille Gaynor. So definitely check her out. You know, go subscribe to her YouTube page, check out her works. Right? Very talented sister, and also a day trader. Right? Got into the game, and she's taking it to the next level. Took a chance on herself. No one else but herself. Anytime you come into this fold as an investor, trader, basically you're not taking a chance on nobody else. You're taking a chance on yourself. You're taking a chance on the information, the data, and then you're just going out there applying it. Right? Having, again, a good trainer or mentor, someone of that nature is just there to help you evolve and bring it out of you. It's already in you. Right? 100% right, brother Tiarca. Right? All right. Is that female? Okay, that's a brother. That's a brother. I want to make sure I got it right. I want to disrespect. Yeah, but that's it. Buy the rumor, sell the news. Right? Buy the rumor, sell the news. Right? We know that to be true. What happened to the marijuana sector? Right? What happened as October 17th? Right? October 17th, Canada legalized marijuana. Right? For the entire country, for recreation and medical use. Right? And up until that, everything that was in the marijuana industry was running exorbitant to the high upside in preparation for that particular that date, that powwow date. Some of them up 300%, 500%, this, that, and the third. Crazy numbers, right? And then right on that day, what happened? Right? All that irrational exuberance kind of went out the window, and a lot of these stocks came crashing back down. Buy the rumor, the news dropped, sell the news, right? Time to take profit now, because now, it's time to get some new bag holders to kind of hold these bags since we done ran it up this far and made all the good money. Here, you come in and hold this bag. I'll be back. Give me about 3-4 months. I'll be back. Right? Give me about a month. I'll be back. Right? But again, that's the power of understanding, when is a good time, when is it not a good time. Again, y'all know my pillars, right? The 4 pillars, right? 4 pillars of success, right? We got some codes and credence over here, right? What, why, where, and when, right? You need to know what you're trading, why you should be trading, or why you should trade, or why you want to trade it, right? Where you should be trading at, and when you should pull that trigger, right? If you cannot answer at least 3 of those questions, do not take that trade. And I know you're gonna be like, oh man, yeah, but that still look good. Okay, if you're confident in that trade, then be thorough enough to realize if it goes against you, that it's all on you. It ain't because the market threw you a loop for a loop. The market's always right. It's not because someone gave you some bad advice, because you're supposed to have double check it. Don't just go off what people say. Do your own research. Do your own due diligence. Be your own person, right? Or you just we're just gambling. So again, we want to make sure we keep our emotions 100% right. Over, John. Keep your emotions in check and let your mind lead you in the right place, right? Keep your emotions in check. Make sure you use your mind respectfully to help you get to the bag, to help you make good decisions. Because this is a industry that's dealing around you being able to to quantify information or assess information. And if you cannot do that with a sense of some value of a methodology, so to speak, right, or some kind of value of science, so to speak, right, then it'll burn you, right? Because you'll just be out there just pushing buttons, don't know what kind of buttons you pushing. Like, what's this button? I think this right here gonna be the one. Boom, and you push this button, and right, you all over the place, right? You haven't found out, what's happening here. You need to find out what these buttons are. What's happening here? What's this chart, values is saying to me, right? What is this news kind of saying to me with this press release, right? What are they really saying about a PDFU, or something like this, or FDA grant, grant more or less than it being an FDA approval, right? Or an FDA acceptance more or less than the FDA approval, right? So again, all that stuff matters, but you'll get there in time. But the thing is that you need to be patient enough with yourself to learn it respectfully and rightfully so, right? Don't rush your process, because the market ain't going anywhere. I guarantee you that. I may be having moments where you like, man, I need to be in the market now because all this money being made, the market either going up to the moon or selling off like crazy. But that don't necessarily mean it won't come around again. And there's always money being made every single day in the market, every single day, even when it seems like unrealistic conditions because it don't necessarily fit your strategy or your modus operandi, how you trade. That does not mean that someone's not making money. That's what's awesome about this. Somebody's always making some money somewhere, right? And if you understand how to utilize this thing again properly, right? How to make sure that you're at least A1 and thorough in terms of how you value certain aspects of the market, certain sectors, whatever the case, certain chart setups, whatever the case, certain fundamental values, whatever the case, and you go find that one that's that's a sleeper, so to speak, even though other people might be watching, and then you can benefit off of it too. That's what this stuff is all about. So that's what this is all about. Yeah. Hey, what's going on, family? Big Ron Apple, good to see you. Power and profit to you, family. Salute to you, family. I would definitely say, man, we definitely have a bear market fog right now. And if it's not the real deal, it's definitely a fog. But I say this right here: when Dow hit all-time high, even Nasdaq hit all-time high, SPY hit all-time high, and you look where they were then to where they are today. Now we talk about stocks that, on an average, like small single equities that run up, so much in the year annual, they may run up like 70%, then pull back and close out around about 40-some% on the end of the year, right? Again, major values of correction, right? Again, no one wants to kind of have that kind of deep level of correction, but it's still notable that you still profit. So if you look at the Dow, you look at the S&P, right? You look at the Qs, all these different indices, exchanges, this, that, and the third, and how they perform up to this point. It would be almost like inevitable that they have to kind of cool off a little bit, right? Because RSI's got to cool off, oscillators have to cool off, right? New buyers have to come back in. Again, you have to revamp your offense, right? They stressed out. You done took them, always to like the fourth quarter, 5 minutes left, battling hard, and a lot of them wore out. You got to bring some second string in, so to speak. You got some new fresh legs in, some new fresh buyers, some new fresh sellers, whatever the case. But that's pretty much where this market's at right now. And because of that, there is a bear market fog. That's exactly how I would liken this market to right now. It's more of a bear market fog, right? It's a bear market fog, and as long as it still hovers, like being in the what's the little indicator? The I think it's like the what is that indicator? The cloud, right? When you kind of in that cloud, that asset's hovering within that cloud, that kind of uncharted territory, sitting above the 200 moving average or something of that nature, and it's sitting up there in what they call a lot of buy opportunity, buy territory. Then okay, that's a money cloud, right? But right now, again, the entire market as a whole, again, you go back and put this thing on the 52-week chart, history value, this is a very needed so-called quote-unquote correction, right? This is a very needed correction right now. And because that is kind of pulling back in a lot of different industries, obviously we know tech is getting beat up more than all of them, it seems like. It's like they're just punishing tech. But who wants to be paying $400 for a share of Netflix right about now, going into the holiday season? I'll wait. Who wants to be paying, 220 some odd bucks, 210 bucks for a share of Facebook right now, going into the holiday season? I'll wait, especially all the press release they've been getting lately. Who wants to be paying $230 for a share of Apple? And they're constantly raising the price of their phones up to $1,000 to the point now they're trying to price in that every phone at this point going to be right at near $1,000. They're inflating their products again, juicing the common people. Who wants to be paying $230 a share for that for Apple right now? I'll wait. Who would want to be doing anything of that nature in terms of intellectual understanding of wanting to buy something high only to sell it low, unless you're a short seller? Right? No, the goal is to buy low, sell high. Right? So Amazon, 2,000, hit 2,000. Who wants to be buying a share of Amazon right now at 2,000 and knowing they need to do a forward split to bring that price back down to more back to earth a little bit for new investors to come in and want to invest in it? Again, without us having to go through and buy ETF values of it and get fractional shares. Right? Now I want to own a whole share outright. I want to have my own prospectus value based upon my share value that I bought a share of it. So when you think about it from this perspective, that's why I tell people it's never too late. Don't think about what the stock is at now. Again, it has merit, but if you are a value investor, if you are a value trader, you look for moments like this. You look for moments like this. Hey, what's going on, family? I'll help Trump get to 1,000 subs. Hey, what's going on, family? That's a cool name, right? Oh, Donald Trump, huh? Right. Hey, good to see you, family. T-Bone. I see my family T-Bone in the house. Salute to you, player. Good to see you, over. As always, good to see you, family. So again, I'm just asking some very basic questions, guys. These are some natural common sense question. Would you rather pay, $300 for your favorite shirt, or would you want to buy that same shirt if you could, a few months later, for like $70? That's the kind of understanding, so to speak, in terms of investing or value investing or whatever the case, that you need to kind of keep aware in your head when you're seeing these stocks run up these higher pricing, and you may be in that stock. I get it. Like, man, the stock pulling back now. Man, I'm losing all my little profit value, my profit share now. Well, this is why it's important to know certain values or certain levels in that chart history that's kind of telling you or screaming you, say, hey, take some off the table right here. Take a little bit off the table. It's okay to pay yourself. It's okay to hit that sell button, guys. Basically what I'm saying, it's okay to hit the sell button. And if you don't clear the entire position out, it's okay to take some off the top. If you got 100 shares, take a third off. Pay yourself, a third of that value, right? Or maybe half. Especially if you done made more than what you initially invested in, you instantly want to take what you invested in out of the game anyway. Put that back in your bank account. More importantly, put that back in your money market account where it should be anyway, where it needs to be kind of accruing some value and interest. Get out these old dead little savings account that ain't paying you money on your money, and they turn around and loan it to other people to make, go out there and give them acquisition power. They can go out there and open up businesses and choke your other businesses out. Again, y'all know the revolving door. Y'all know how this stuff works. So all I'm saying is just be understanding of, in terms of what financial literacy really means. Being, again, astute to everything around you. Don't go into this world with a very myopic state, mindset, thinking that it's just one way and one way only. No, there's a lot of ways. There's this way, there's that way. There's shades of gray in life, right? There's shades of gray in life. Everything is just not black and white. Everything is not on and off. Right, everything's not hot and cold. There's warm, there's lukewarm, right? There's temperate or whatever, right? There's different colors, So y'all get my point. So again, you want to be, again, sound to all that. You want to understand the complexities of all that makes this opportunity well worth your time and also well worth your dollars, right? Your investment, right? Your trade value. If it's just for a 2-minute trade or 1-minute trade, again, we know people juice 3 to 4 seconds in the market, they up, tons of money because they leverage their account and really, into a stock really good. The stock did what they want to do. They out. So, again, you find me a scenario that offers us such an opportunity like what we have in this, that gives us such an opportunity to make the kind of money that we make, and obviously in a short period of time. If there's something out there better than this and that under that regard, then by all means share that with everybody. Share that to the fold, so to speak. Share that to the family, right? Because again, what we have is something very special. And you don't regress in this. You get better over time because even your mistakes will force you to make better decisions. Right? That's one of them Ralph moments, right? Can I get a hello there? Right? Infinite waters diving deep today. Y'all gonna learn today. That's a Ralph moment, because you got to realize, where you are today, in essence to what we're doing in terms of learning this, it's only going to get better. It's only going to get better. You're only going to get better. Technology is always improving in a way where it's kind of giving you somewhat, quote unquote, the easy way. Not necessarily always make it the best way, but it's trying to present you data and information, basically at your disposal in a moment of seconds, nanoseconds. And then from there, you can make an educated decision right on the spot, right? Again, a CEO kind of decision, a board of directors kind of decision. You're doing that every single day when you trade these different assets. I don't care if you're short and going long, what different asset classes, mutual, ETF, crypto, Forex, binary, whatever you still have to be able to make executive decisions literally on the fly. And that being based upon your ability to assess data and then make that move. That's why ain't nothing like this right here. That's why this right here is like the business, because again, you don't have to be waiting or dependent upon someone else to give you a bag, or you got to go work hard to get you a bag. An unexpected bill come up on you right away, right? And let's say you might have been, you didn't want to trade the market today. You got you're looking good. You got other stuff to do. Unexpected bill comes up. You're like, well, where am I get this money from? I don't want to dig into my account, my savings, and my checking or whatever to pay for this. I tell you what, give me about a couple hours. The market still open? Okay, great. Let me go see if there's some out this market that can help pay this thing off today when I ain't got to spend on my own money. That's privilege. That's opportunity. That's what a lot of your peers cannot say that they can do. Again, let's if you go out there, do the other stuff, the pharmaceuticals or whatever, or go out there and do some other wild stuff. But I don't always advocate that. But y'all get my point. We say, well, okay, that's fine. Okay, give me a minute. Let me go fire up my computer. Or let me fire up a lot of stuff on your handheld devices now. Right? Let me go assess what's happening real quick in the market. I always keep your ear to the street anyway. Let me go see what's happening. Let's see if there's some opportunities today. Or what's selling off today? Okay, retail selling off today. Man, these stocks getting beat up. Let's see what one that has a little bit more room in. Let me look at the chart real quick. Right? What's the volume looking like? If there's any kind of notable catalyst right now, right? You just weighing your option. What the chart, and you just say, okay, I'm good. Right? I'm already pretty leveraged right now. All I need is like a couple $100, no problem. You gonna make that money, and before you know it, it's like, what did I just do? I just paid this off like in no time. I just see that's when it becomes evolutionary, right? That's when it becomes you're like, man, I mean, I get it now. I get it now. I get it now, and I know what I needed to have done to be to put myself in a position to be able to do it. I took the craft serious. I studied when people were going and hanging out and do all this stuff. Hey, I'm good, guys. I'm finna get into these books. I'm finna go watch this video, right? I'm finna go read, how to day trade for a living by, Andrew Aziz, right? I'm finna go, I mean, all the different books and PDFs and video. I mean, it's a plethora of it. Again, a cornucopia of opportunity out there. So it's not that the information is not there. It's just that a person just don't understand their power value yet, especially when it comes to financial literacy and using the global markets to help them facilitate bringing in other supplemental value or other values or streams of income. I'm not even say supplemental income, right? Because it's easy. This can easily turn to primary source income if you know what you're doing properly. Again, we know people that fired their boss. Y'all know that's one of my biggest mottos too. Let me show you how to fire your boss, right? Or let's get you excited about learning how to fire your boss, right? I know people that have fired their boss, and they are full-time investors and traders, and they living their life, on their terms. So to me, that's exciting, but that, again, everybody's different, so I see my family, Mr. JRH, that came in the house. Good to see you, family. Power profit to you, family. I see my family, D Skizzy, that showed up. Power profit to you, family. Good to see you guys, right? Getting after the market, right? All right. You say, is that the scene from Trading Places? My kid want the G.I. Joe with the Kung Fu grip and the woman won't give any love. Hey, you already know what time it is, Over Jonathan, right? All right, Apple lost a lot of institutional money, announced the next release of a quarterly sale. Again, phone sales dried up. Exactly why I shorted Apple into earnings. It's exactly why your brother, African Emporium, right, shorted Apple into its earnings. Why everybody was saying, oh, they're going to go to the moon, they're going to beat. No, go look at the metrics. All the information was out there. The tea leaves already been dropped and shook and read at that point. It was already obvious that they were going to miss. Tim Cook had been coming out, pretty much religiously telling everybody, hey, we're going to come in a little light. China phone sales not looking too good right now. We're having to cut back this, that, and the third. They were already telling people. They were already warning people that they was going to have a light quarter. The Q3 report was going to be light. And they trying to get ramped up to drop this new phone. A lot of this stuff, again, is common sense observation. Again, a lot of it is. I know it's still other stuff you got to do. I get it. But if you just really step back and really observe these companies, because before we became investors and traders, we used to look at the market from a consumer perspective. We knew everything, when it was coming out, how it was coming out, what's the price point, what's its competitor, why is it not a good time now? Why is it a good time? You knew all that stuff down to like a science. Now take that same skill set and flip it now. Get on the board of directors side of the house. That's basically what you become as an investor trader now. Get on the board of directors side of the house now and start using that same psychological disposition to think about how your customers are going to respond to, your new products, your new valuable advertisement, whether you're cutting back this or you're adding this, that, the third. What would that buyer be thinking? And from there, you can learn how to, again, trade these companies, these assets under that kind of that mentality. Based upon, again, some other little, data points here and there, but that's all it is. It's just Let me go see what Apple doing right now. When the last time Apple did this? Is they doing an merger acquisition? You know, what's the data numbers on Apple iPhone sales as of today? I mean, you can just go plug it in stuff like that literally into Google, and then information will start propagating. Man, I thought only you had to be at the company to find these kind of numbers. No, you got to learn how to research. Again, methodology, right? We do it for everything else. You know, why can't we do it for, you know, again, utilizing the market to help us get to this, you know, get to some kind of point of confidence to take a trade. You know, so again, I just, you know, I just say, you know, guys, we got something that a lot of people are afraid to do, or they fearful of it because they don't understand it. But if they knew what we knew, what we know now, and we're still growing and getting better at, they'll be like, I should have been doing this 5, 10, 20, 30, 40, 50 years ago. Like, what was I doing? And I was just blowing money on stupid stuff. Blowing money, just like blowing money on stupid stuff. And I'm like, man, I could have been putting that money to the market. Dollar cost averaging in on the market. And let the compound interest alone before even the accrual value of the stock price of the growth value growing, and been sitting real nice right now. You know, but again, the greatest thing about this, guys, is it's never too late. It's never too late. And you're always going to, again, get better the more you find time to, again, kind of get lost in the sauce, so to speak, get lost in the data, get lost in the research, get lost in the due diligence, get lost in being around the information to the point where it becomes a part of you. Again, as I always say, repetition becomes repertoire. Repetition becomes repertoire. Let that marinate. Simple as that. It's pattern recognition. It's trend recognition. Is that not what we do when we go trade these stocks? We go looking for patterns. We go look for trends. We go look for sectors. We go looking for, you know, where the money at, where the sellers at. You know, what's the geopolitical news like? What Trump's saying today? You know, what Jerome Powell gonna say today? What President Xi from China gonna say today? What's Theresa May gonna say today? What's, you know, Job, whatever his name is, the guy over there that ran, whoever these people, whatever. Again, all this stuff is just basic stuff that you can go cut on CNBC or CNN or whatever, Fox News, whatever you watch, and get some data points off that. And then you go back and apply it to the market. Okay, this sector is going to be affected by this, right? This whole issue with Iran, I'm still dropping a whole ton of oil into the market right now, oversaturating the market right now. And on the price of oil, it dropped below $55. Oil was sitting there over $70-some, literally about what, 3-4 months ago, over $70 a barrel. But guess what was interesting about that time frame? Again, think about cyclical values, right? Cyclical seasonal value-based companies that make a lot of their money or make a lot of their profit share during certain times of year, because this is their heavy rotation series sector where people are consuming their products or their services. Again, summertime, kids going to school, off from school, vacations, you know, flying planes, all this stuff, travel, people travel, right? And then kids go back to school, everybody a little tight, money tight, you guys pay for this, pay for that. Like, hey man, some of this stuff takes a haircut. Not always, but again, you learn how to assess the cyclical value even of the market. You'll also know how to trade it. That's where some of the earning plays, it's easier to figure out how to trade these stocks because they're giving you telltale signs basically what's about to happen, going to their next particular fiscal quarter. Because again, we just went all in, you know, in Q1 to Q2, the juice up, you know what I'm saying, the books. And now it's time for us to take a break because we didn't blew through all of our free cash flow. We blew through all of our free cash flow to the point where we can't do any kind of major R&D or M&A at this point, because now these products that we invested in earlier have to start becoming profitable now. I invested in that stuff a year ago. It has to start going to work today. So right now we're going to be a little light going to the Q3 or Q4 because again, you know, we got to get this product or this service time to mature. We got to see how the public going to receive it, and then from there we'll pick up again possibly in 2019. And on top of that, the markets and everything at this point is just superly at nosebleed sections. It's time for everything to kind of take a correction right now anyway. You know, so again, common sense, got a lot of this stuff is just very natural, common sense, and natural wit, natural observations, things that you already was doing before you learned how to do this stuff. When you watching your favorite football team, basketball team, baseball team, soccer player, race car drive, you just revolve around. It all revolves around stats. It revolves around stats, right? And the rest of it just them going out doing the mechanical stuff, but it's still a lot of stats that's just kind of wrapped up into it. And again, that's how this stuff is set up. It's stats. It's numbers, charts, stats, data. you know, in whatever direction order you want to put it in. But that's the game. That's the game of an investor or a trader. The intricacy comes in terms of how to value, look at the market, assess what's happening, spot the weakness, spot the strength, and then you capitalize on that moment. You know, so it's exciting and it's rewarding, but it's suited for those who are willing to put in the work. You put in the work, you'll get rewarded. And no one can block you. No one can stop you. No one can't discriminate against you. No one can't, you know, throw a cog in your wheel. Right? Unless they come steal your computer or something like that. They come steal your pewter, it's a wrap, right? They took my pewter. Right, well, that's all right. I got my cell phone. Just thinking, jokers, I'm still going to get this bag. You can't stop me. Bam, you know, but whatever. So again, it's like process of elimination, right? It's like deductive reasoning, right? It's like, you know, least path of resistance, knowing who, where, when, you know, whatever the case. Again, make it make sense, guys, in a way where you don't have to fight this opportunity. Stop fighting the market. Stop fighting the data. Again, you may not agree with everything. That's fine. But at the end of the day, the market is always right and the opportunity is always there. Let me say that again. The market is always right, but the opportunity is always there. Right? Now, you just got to figure out how you're going to plug yourself into that equation, right? And make sure you walk away what? Profitable. That's all it is. You know, so again, few new people that came in, I'm sorry. I see my over Derek that came in the house. Over Derek Hartwell in the house. Thank you for coming by. Over, good to see you. Salute to your family. I see the fam. Who is this? Queequay. I guess I'm saying that right. I don't want to murder your name, family, but I see you for thank you for coming in today. Salute to you. Well, I think it's Queequay or Queequay, right? Good to see you, right? Can you just send me your actual trades you made today? Yeah, I'll go over some of my trades. Yeah. Yeah, no problem. Yeah, so I have CNBC on the background while I'm trading 100% right. I always got market, you know, news going in real time in my, because I didn't know if something dropped like in the spare of the moment, I want to be able to catch that. Sometimes catch a lot of stocks and make a good little bag of, like, you know, spur of the moment news, like breaking news. So finna do a buyback, or they did a merger acquisition, middle of the day, stocks are tearing it up to the upside. Oh, let me go over here real quick. See, that's the power that we got. You come in right on that and see what's happening. Okay, yeah, look at the chart. Charts look good. Right here, I'm gonna take my position right here. Boom. Stocks get to ride now. You came in and picked up your nice little bag in about 5 or 6 minutes, if that. You know, it's like, what did I just do? I just made, you know, $200-300, $500, $1,000, whatever, $20, whatever. You know, that's what I'm talking about. That's that. You know, we privy to that. Right, well, somebody else is right now, again, no disrespect to them, right? Somebody else right now is sitting there watching the paint dry, waiting for that clock to hit another hour tick. You like, hey, God, God, dog, bro, come on, clock, you tripping. You've been sitting at this 145 for a long time, bro. What's that? Is the batteries in this thing? Is this thing on? You checking the, hey, what's wrong with the clock? It ain't moving. You know, they sit there watching the paint dry. You know, so again, I say all that to say, you know, again, if we just get serious about this opportunity in a way where we know that it will just, you know, again, we just got to cut a lot of the kind of the crap out of our life a little bit. You cut a little bit of that, a lot of the trivia stuff out your life a little bit. Again, I'm not saying you have to go live in a bubble, separate yourself from everybody, this, that, and the third. I'm not saying that. All I'm saying is learn how to compartmentalize your intellectual value in a way where you can monetize it. Learn how to compartmentalize your time and your prowess and your intellect in a way that you can monetize it. When you can find a way to do that, it is game over. It is game over, right? And when you think about, again, the overhead that requires for us to be able to do this is basically capital, knowledge, and a signal and a device apparatus to do it with, basically. That's it. That's it. And you could be like me. I be, you know, y'all know I kayak a lot. I love outdoors. Y'all, you know, go, you know, kayak up, you know, mile up the stream somewhere, a river somewhere, and I'm still trading. As long as I got a signal, I can still trade on the water in the middle of nowhere. You know, I can still get to the bag. So my place of business or my place of work is everywhere. You know, it's everywhere. As long as I got a signal, I'm good to go. A lot of people can't say that. You know, so again, I advocate the market this way because I realize what it is going to do for each and every one of us when the light bulb really goes off with us. I just know what it's going to do. I know what it's going to do, guys. I can't stress it. I'm excited for that. Right? Hey, what's going on, family? Brian Garrett, good to see you as always, family. Power Property salute. Right? I'm humble. I'm humble. You already know I'm humble, family. I'm humbled. I'm humbled and honored every day I come before you guys. Again, y'all know my disposition. I'm always humble, right? So again, I'm humbled by that. Thank you, family. You say so. MVS, yeah, dropping on negative news, negative news day, right? MS news, right? Again, that news dropped right away. Boom, you know, assets are moving, right? Money's being made, right? So again, yeah, Novartis, I know about that company a lot anyway. We've been traded several times, right? Just pulling up right here a little bit on Thinkorswim right now. Yeah, it's coming down. It's stuck here at 87.13 now, 87.15 now, right? So again, he said it dropped on some new. The 86 yeah, it's going down right now. Press release just happened. Well, not just happened, but again, FDA warns about worsening of multiple sclerosis after stopping the Gilenya. I think it's called Gilenya. So one of their drugs is being flagged a little bit by the FDA. It's making the multiple sclerosis get worse based upon that, and the stock's starting to drop right now. And look at the drop. It dropped from $89 all the way down to 87 right now. It dropped $2 a share, and the stock was up on the day. It was up on the daily, guys. This thing, see, that's what I'm talking about. It just happened. See, that brother was probably watching this stock or got the news when it just dropped, and he could have got right in it, right on, you know, obviously early ahead of time, front loaded it. Right now, and they're already up like $2 a share. They're already up $2 a share in profit on this stock right now. Guys, where else could we do this and make that? Again, you could have came with 100 shares of an $89 stock. You know what it's going to cost you? That'll cost you about what? $8,900, whatever the case like that, right? Right? Cost you about $8,900, right? It dropped $2 a share, right? It dropped $2, you know, $2 from the, you know, the high point at that point. So roughly about, it started dropping at near the high around 89.08. It happened literally around about 12:58 near 1 o'clock. So if you got short right in that moment, you bought the puts right away, right in that moment, or whenever the news started coming out, or whatever the case, even if you know what you didn't know, you already up $2 a share. You're basically already up $2 a share. You know, so nice little 100 shares, $2 a share. You done picked up a quick little $200, a quick little $200 in a matter of 1 o'clock. And right now it's what? About 2 o'clock here, about an hour worth of work. You walked away with a $200 bag. And the only thing you did was caught the news, pushed the button, and then you sat back and said, yep. And you probably still got a little bit in there. If you didn't take it all off the table, you sitting there like, yeah, I think this game gonna go lower. Because you go look at the previous chart here to see if there's any weakness that it may crack and go lower, potentially whatever the case, and you can just, just continuously keep eating. So this is why this stuff is exciting. You see, you got a late short at 87.75. Going to see if we can go under 87. Again, yeah, it's over the week right now. RSI just had to reset a little bit, cool off a little bit. Basically, what I see right here, I see RSI cool off, right? It's typical. It seemed like it then bounced back and hit a key level of resistance. It didn't close above that highest candle that is left out of. Then that last bearish engulfing candle where it closed, opened up around 87.38, right? And so in order for it to really show some reversal strength, number one, it has to clip that candle, that 5-minute candle. And then it would have to obviously definitely, get back above, that resistance point about 87.60, 87.50, 87.50. Obviously, natural $half marks and natural resistance points to the upside, right? So again, looking at the chart here, it's still in trouble here. As of now, level 2 looks pretty decent. I don't see any kind of crazy buyers trying to rush in to buy here. I mean, you see a few people trying to scalp it here off the bottom, and that's typical after they drop this much, right? So they have to come in and act like they really want it, right? And I see the buyers trying to step up. I see some sellers still trying to sell it as well on the level 2. So, but again, we talking about opportunity, learning how to trade this properly. So, I would say, okay, well, let me see if it can get back up at just 87.33, 87.35. Right, if it don't get there because it can't clip this last candle, just actually close out of it may show weakness, start rolling back over. So now all I would do at this point, look at the level 2 Let me see if I got any kind of sell side activity pressure start to show up in the stock, even more, meaning more people trying to sell. I look on the time and sell side, all I see is a sea of red. That means people are still selling more than they're trying to buy, right? So I'm like, okay, it's not gonna let me get back all the way back to the 87.39. I see 87.30 as a good point to try to, particularly take a little short on it, right? Based upon the energy here, and I'll take that short right around that time frame there, right? And I'll put a tight stop loss on it, 87.39, 87.35, and the thing already rolling over already. It's already rolling over already, right? So again, in that moment, we took a short at 87.30. We already up 20 cents a share right now. Even more now because it's going low. Now it's gonna get ready to actually break 87. Right now it's gonna get ready to break 87. So again, money. You picked up 30 cents a share dang near in a matter of literally, 1 minute. And this is the 1 minute chart. I forgot this is the 1 minute chart. I'm looking at the wrong one. This is my 1 minute chart. So in 1 minute, you done picked up 30 cents a share. I'll wait. 30 cents a share in 1 minute. Again, 100 shares. 30 cents, you'd have picked up 30 bucks. That's dinner, that's whatever. It's getting ready to break. There you go, it just broke 87. And it dumped hard under 87. I was just getting ready to go actually go trade this stock too. I was like, let me go hit this thing. I'm about to hit this thing because it looks good, hit this 87.30. Right? I was just thinking to myself that, hold up, guys. I'm gonna say, hold up, guys, give me 1 second. But it already dropped at this point. Now it's down to 87, went down to hit 87, 87.82. So from 87.30 to 87.32, how much money is that? You picked up base about there 50-something cents a share in that moment. So quick 50 bucks in about 2-3 minutes. 2 minutes to be exact. Right? 3 minutes. 87.30 was right here. So about 3 minutes, you picked up $50 a share. $50 in profit off 100 shares. So again, opportunity, right? Say it till you get tongue tied. It's like, there's no place like home. Click your heels, flap your arms or whatever, pat your head, and rub your stomach at the same time, right? You do two things at one time, multitask. Again, opportunity. So you just, this stuff just gets you excited. It's exciting. It's exciting. So we live for this moment. We live for these moments, I should say. We live for these moments. So that's why I say it's always money to be made. There's always money to be made. And if you know how to, again, assess information, assess charts, assess weakness, assess strength, whatever the case, then again you can put yourself in a good position. You can put yourself in a good position to benefit, to benefit. So again, I keep saying and I keep stressing and I keep reiterating, this is why it's important that we get solid about learning how to do this. I'm not saying just get passive and say, I'll study and I study right now. I study a little bit, or I just go out there and take a chance. No, get really active about wanting to be like the best you can be at this. And it doesn't require nothing of you but some time. Your smartphone got everything you need, basically. Your tablet, your computer, whatever, got basically everything you need. The rest of it is on you. So it should excite you to want to be solid at this. It should excite you and ignite you to want to get after this market. So again, I say, see, there you go. See, brother picked up 150 bucks in 20 minutes. He done picked up a cell phone bill in about 20 minutes. That's 150 bucks, guys. Somebody right now on the job, probably it took them all day to get that, to make $150 today. The brother just made that in 20 minutes. Let that marinate. Let that marinate. So I'm just saying, opportunity when it arises or when it presents itself, you have to be willing to capitalize on it if everything checks out and it makes sense. It has to be willing to make sense again for you to be able to capitalize on it. In that moment, that data, that news, that press release, or that breaking news, it made sense. Market's already turned over as it is right now. The market's still selling off as it is right now. And here it is. You got, you know, an asset that came out of nowhere and started rolling over, right? Just out of nowhere, it just started rolling over. The SPY rolling back over right now on the back end of the day, right? Low of day on the SPY is already at what, 263.20 something, or 263.30, somewhere around there. You know, so again, this is exactly what we live for. This is exactly what we live for. You know, I've been crushing the last couple of days. I've been tearing it up. Yeah, again, hey, you showed me some blood in the streets. Oh, you best believe your brother finna be all over it, right? Your brother gonna be all over it. Y'all know me. Hey, I always say there's a method to my madness. There's a method to my madness, and all I want to do is share whatever little angle I can help other people be, grasp some value that they can utilize it for themselves too. Exactly why I'm always up dropping it, information off in these chat rooms, the Discord rooms, and whatever. I enjoy that. It's again, what I'm also doing is just permeating my mind to make sure I'm solid on the data and the information on the stocks of this, that, and the third. So I have a war chest of opportunity, a war chest of different stocks I can trade. There you go. It's going lower now. New low of day. New low of day on this stock, 86.75. I was just going to try it again, hit the 87, $18, $15 level. Kind of pop back up and retrace the RSI, cooled off a little bit. It's going lower. I'm not going to touch it now. Now, it's probably still some opportunity in this stock right now. I'm not going to say that it's not. But I mean, I had two entries that I could have taken this stock right now. I didn't take them, but it's still showing to be very profitable based upon what? The sell side activity, based upon the level 2, based upon the news or the catalyst, the fundamentals, and the chart setup is still looking good. Now, if I go back and look at this chart history, let's see where was last time it was sitting at this point here. Let's go back to the let's pull up the 10-day. Let's see what the 10-day look like. Okay, nope. Let's go back to 86.44. New low of day. I think here 86.44, guys. Y'all playing around. Y'all want the money. Let's go back to the 4-hour 180-day. Right. So again, major correction, guys. Guess what? This stock is actually at the T line right now. Its trend line value is basically showing up on the linear regression line as at a major level of support now. If it breaks this level of support right here, if this thing breaks this level of support right here, this 86.55, this thing can get ugly. It can get real ugly, right? It can end up definitely down here near, before you know it, 84.22, 83.90. It can get ugly for this stock. This thing can get real ugly real soon, guys. Here, looking at the chart here. And they're getting ready to break this 86.40 handle in a minute, 86.48. The level 2 are already over the place. It's mad with the bulls are running, backpedaling right now. They're backpedaling. There it goes. There it goes. There it goes. See, this is why this stuff. This is why I love this stuff. This is exactly why I love this stuff. Right? This is exactly why I love this stuff. This is why I don't mind being a home nerd or whatever people want to call you. Like, yeah, let them talk that trash. We finna get this bag. There it goes. All right, so man, opportunity, guys. That's all I'm saying. Yeah, you got out a little too early, but that's all right. A bird in the hand beat one in the bush, brother Brian. 100% right over Chris. 100%. Just made $50 off of. That's what I'm talking about. I need some sound effects. I ain't got that technical, all that good stuff. Yeah, I get to some bells and whistles at some point. All right, I get some bells and whistles at some point. We're able to do that. I'd be like, yeah, ding, ding, ding. But again, that's what I'm talking about. That's exactly what I'm talking about. The sheer opportunity is there, right? The sheer opportunity is there. Hey, what's going on, family? SNN? My bad, I forgot. I didn't see that message. Good to see you, family. Power property to you. Salute to you, family. I understand trading the market is very powerful too. How do you make your money work outside of the market? Again, great question. Very great question, right? There's real estate, right? There's other VC projects that you can get aligned with. There's again crowdfunding values, but you can come in on some of these stocks at an OPO level before it becomes an IPO. I'm actually invested in 2 companies right now that haven't went publicly traded yet. Right, they're offering par value shares to come in early at about I think one of them is at $1 par value, and the other one is at like I think it was the Class A round, second round. I think that was like par value around 10 cents, somewhere around there. You can come in and get in early on some of these stocks now. Before, they wouldn't allow people like us to be able to do that. You have to have a accredited broker's license or something like that nature, or be a part of some hedge fund or accredited bank to be able to come in and buy these companies at startup level. Now they're giving the general public like me and you opportunity to be able to do that now. Right? What's that website? Start Engine. Matter of fact, let me post it. Y'all gonna get this work today. Y'all gonna get this work today. Right? Let me go find that asset. I think it's called Start. Start Engine. It's not Start Engine. It's hold up. What is it called? Let me find it real quick. 1 second. Excuse me. All right, I'm definitely gonna post that site, because you can go in there and just look through the different companies that are releasing products or whatever before they go public, and you can kind of invest in them early, right? And if obviously it goes public, whatever the case, you coming in, or it's kind of like ICO if you buying crypto, right? You coming in early before the stock obviously takes off. Some of the stocks end up running, or assets end up running 5x, 10x, some of them 100x, right? You come in early at the ground level, you rolling in the dough. Again, that's when you start seeing Lambos. All the kids like, I got a Lambo, right? We know people that actually did that, So again, who are we to sit back and act like that opportunity is not available? It's just all about you done your homework, you due diligence, you feel comfortable in doing it, and you take that opportunity and you get in early, right? Or whatever the case. But however, the opportunity is there, right? Again, that's outside of the stock market. You putting that money to work in other avenues, right? Again, crowdfunding. You go open up your own businesses now, right? You go put that money into, again, trust and funds. Other little things you can do, mutual funds, whatever. Again, outside of real estate, drop shipping, product development values, where you can come in and or again buy products at lower price value and sell them high. Again, go open up your page on Spotify, Shopify, right? Sell you some products online. There's always money to be made, obviously putting it to work properly, right? We just need to be privy to the cash, right? Be privy to the opportunity, to utilize some capital to make some moves, right? The worst thing you can do is have an opportunity right before you, and you can't put a trigger on it because you don't have enough, your pocket's thin, right? That's like the worst feeling of all time. Like, you see the opportunity, you see the payout, you see the bag, you've already done the math, you see the metrics, and you can't put a trigger on that thing because again, your money ain't right. Right? You're like, man, why am I missing this opportunity right now? Right? And that in itself should convince people right there alone, like, man, let me get serious about this here. Right? Let me get serious about my money here. Right? Let me get serious about my future, more or less, right? Get serious about these resources, because when you think about it, when you have that entrepreneur spirit or that entrepreneur mindset, you know that you won't be denied, right? Because you have the drive, you have the passion, right? You have, a lot of, what it takes to be successful, given you had the opportunity, right? Given you had the opportunity, right? So again, that in itself is exciting. That in itself is exciting, right? And it should, again, invigorate you to want to become more solid at, learning more about different asset classes that you can obviously take your money and invest in it through. So this stuff is just, to me, it's just like, bro, let's go. You know what I'm saying? Let's go. Right? And it's exciting. Again, it's exciting. It's very exciting. Right. So this one little company here was one of them that I invested in here. All right. Let me see. All right. So let's go. 1 second, guys. Sorry about that. 1 second. One second, guys. I'm trying to get this website to post it for you guys. Some of you guys probably already know about it. It's called Start Engine, though. But either way, I want to make sure, we can. Right. We can, all right. 1 second. Only 1 second, guys. Right. Go back here. All right, here we go. All right, boom. Sorry about that, guys. Actually, I was going to check my old investment. All right, but yeah, that's it right here, guys. That's the website right there, guys. Startengine.com. Right. So sometimes those par value shares that they're offering, Class C, Class A, some of them different, par value where you're voting rights, some of them may not, but you come in at the early stages. And if it makes sense enough from an innovation perspective, you can come in early. You give the stocks a little time. Give the assets some time. It goes public maybe a year from now, 2 years from now, even 3 years from now, whatever the case. Whenever it blows, you don't need to worry about it because again, that's a set it and forget it kind of opportunity. You would blow that, $100 in a matter of 2-3 years, well over that on crazy stuff. Again, trivial stuff. Here it is. You say, well, you know what? I'm gonna take a chance here. I'll put 100 there. I put 200 there. I'll put 5 here. Whatever the case, obviously it comes with a prospect, so you can obviously be able to track your money. You can track the company's performance. Same thing we do with fundamental analysis when it comes to checking these stuff. Comes like Apple is at the third, and then you can come in and say, okay, boom, the stock goes publicly, it opens up at IPO like a Snapchat. IPO like a Snapchat. Think about that. Open up above 20 plus. They had the thing, value well over, what was like, I forgot how much $1 billion it was. Whatever the case, I remember I traded IPO, Snapchat IPO. But either way, think about all the early investors that came in at par value of 0001, right, or 10 cents or $1 per share par value of the stock, right? That one little, I think it was like a Christian school or something like that. The school actually made a school commitment investment in the Snapchat. Some little school over there in California, and when it went public, they cashed out. I think it was like how much? Like millions of dollars. They only put up, I think, like $100-some thousand, something like that, even less than that. I think some of them like it was all over the newspaper. But whatever the case, it was $5 billion FPO. They put up like $100,000 somewhere around there, some amount of money. Y'all can go pull up the article. The stock opened up over 20 something, went up to like $26, $27, somewhere close to that. That school picked up a gang of money, millions of dollars, basically. Right? I'm paraphrasing, but they made millions of dollars off that investment because they became an early investor in the Snapchat. So, basically, y'all get what I'm saying here. So it's important once you become an investor in the stock market, kind of answer that question a little bit that you was asking, brother. About S&A, about how do you make your money work outside of the stock market? Case in point, right now, you become an angel investor, a VC type investor, right? And that's what basically when you get money, big money, that's all you do. Now you just go around looking to see if you can invest in other smaller companies or ideals or startups to kind of grow your capital. Again, a la the Shark Tank, a la all these different athletes and celebrities, whatever the case, when they go invest in, these little mom and pop little startup companies or their, whatever the case, they want to get in early, right? Again, Dropbox is publicly traded, right? I remember when I was a beta tester of a Dropbox, the cloud storage company, right? And I was like, man, I can't wait for this company to go public, right? They waited a long time. They should have went a lot earlier than when they came out. But either way, I didn't even know that what the rapper Nas, he's actually invested in the Dropbox. He's actually invested in Dropbox. Snoop Dogg, he invested in a lot of these little cannabis stocks. I mean, obviously, go figure. Go figure with him, right? You know, LeBron James is an avid investor. Kobe Bryant is an avid investor. I mean, there's a lot of people out there. You know, you'd be surprised. Again, some of them, a lot of these athletes ain't so, you know, shallow. You know, some of them are very educated at this point. They got with the right people. Actually, got the right people got around them, you know, good, which is good. It shielded them from the ceiling and got them excited about learning how to put their money to work for them. We're no different. We may not have the capital that they have, but doesn't necessarily mean our capital is just not, you know, that much not, you know, important or potent to that regard. Because again, all we need is a little bit of time, right? All we need is a little bit of time and the right opportunity, and we can get to the bag. Again, you heard the brothers in here saying that they just made quick little $50 in 20 minutes, $150 in a little bit of time. You know, again, that's a cell phone bill, that's a dinner date, that's a portion of, or whatever the case. You know, this Queensbridge Investments, right? Yeah, Kevin Durant, the basketball player, right? So again, what separates them, you know, from us? You know what I'm saying? That kind of like, yeah, what's separating them from us? From nothing. We actually a little bit more hands-on with us because again, some of them may be too, but they got a schedule, they got to keep up with. They got other people to kind of go out and do that for them, manage their affairs in that regard. So they got to pay somebody to do it. Some of them actually got hands-on pros too, but again, for us, it's like, hey, we go do this ourselves. We got this. You know what I'm saying? We got this. You know, that's what we'll be saying. We're like, man, we got this. You know what I'm saying? So I'm just saying, guys, if we can just get, you know, we have to put in that work though. We got to put in that work, right? We just got to put in that work. Again, if we can, as the saying goes, if we can conceive it, we can achieve it, right? If we can perceive it, we can achieve it. However you want to cook that noodle, that bag of ramen noodles, and turn it into a gourmet bowl of udon, right? And go from ramen noodles to udon noodles, right? You had just some ramen noodles, some top shelf ramen noodles, and that thing turned to a bowl of pho. Now you got your bowl of pho, gourmet style, right? All depends on how you dress that thing up, right? So again, we know that the opportunities are there. We know that success is just literally right around the corner for a lot of us, and it's not dependent upon us again having to wait on somebody else to give us the opportunity, right? Or to open up that door for us, right? Or to fill out that resume and go through all that screening process where it's 1,000 other people trying to get that same position you're trying to get, right? Doesn't mean that you need to stop and don't give up on that kind of dream, because you may just have a passion to kind of further that skill set that you picked up going through the educational system, whatever the case is. But at the end of the day, just know that one position or opportunity in life does not define you. It does not define you or hold any bearing over how great you will be in life, based upon that there's other opportunities out there in life that can still get you to where you need to go. And what we know, or what we've been able to quantify as investors and traders that understand the metrics and the data, is that there's nothing out there, obviously, in the instance to what we know now as investors and traders that to give us such an income pool that we can pull from, and literally, a matter of minutes, and a matter of days, and a matter of months, and a matter of an annual perspective. We could never make that kind of money sitting on somebody's job, punching the clock, getting shielded under a pretty much a cap value of what they're going to pay you. It just won't happen. And you got to still deal with the price of inflation, year over year, federal tax rate hikes going up, cost of living going up. And if you still making the same salary you made the year before, that means you actually in debt that following year. That means you actually in debt, going into that new year at that point, because you didn't increase your per capita going into that level of inflation or extra taxation. So you actually in debt. Especially your lifestyle already kind of got you thinned out, and you're not living below your means. You actually in debt, and you don't have supplemental income coming in, which makes it worse because you don't have other stream values, to kind of keep you growing along with the price increases, right? And here, me and you'll come along and be like, hey, yeah, man, the stock market stuff, man. Hey, what do you mean stock market, man? Man, anybody mess with no stock market, man. Stuff gambling. I'm like, you gamble every day when you go to work. You taking a gamble every single day that your boss going to make sure he's doing the right thing with the company in the instant to keep his lights on, so you can have a job to come to. Is that not the same in a lot of ways? You putting all your eggs in the basket in one company, one man or one woman, and hoping that they'll do right, enough to kind of keep you coming in, punching the clock so you can make you some money. So you put all your trust in a man or in his company, but you're afraid to trust yourself. You're afraid to trust data, knowledge, and the same thing that your company actually dealing with anyway, outside of this small nuts and bolts that you're having to do the hard work, labor through, and you don't want to deal with it from that side of the house, the table. Oh, you just want to, okay, I got it. Nothing wrong with that. Again, you just like punching the clock, and I got no problem with that. But again, for us, this stuff is no brainer. It's no brainer. It's no brainer. So again, I just like to always, premise our conversation geared around the things that we already know to be true, but sometimes we trick ourselves out of the opportunity to realize it and actualize it so it can materialize. And we get caught up in our head and realize that the fight or the battle is not with self, right? It really isn't. You don't fight yourself. Open yourself up and allow yourself to ingest opportunity. Open yourself up. Don't be myopic minded. If you don't have, get away from just being, I got to think one way. No, have discipline, have structure, have a value of due diligence, obviously in place. Again, proper methodology, right? But realize that you're here to be an opportunistic minded person. And I say that as a trader. People ask, like, what kind of trade, how do you, what's your strategy? Do you trade certain things over others? This, that, and the third. I tell people, I say, you know what? I'm an opportunistic trader. Simple as that. I am an opportunistic trader. If it's moving and it's current on its filings and there's price action there and there's opportunity there in the chart, this, that, and the third, I'm there. Simple as that. Again, and y'all already pretty much know the only stocks I will not trade are prison industrial stocks. I just won't do it. I go trade NVS, Novartis. I'm not going to invest in a prison stock. Those are the only stocks I want to invest in. Everything else, fair game. As long as it ain't nothing overly crazy, investing. But y'all get my point. Basically, we opportunistic. We're looking for opportunity every single day. Don't let people tell you, no, you don't need to trade one way. Oh, no. Learn this market from top to bottom, side to side, inside out, round and round. Y'all get it. Why wouldn't you, right? Why wouldn't you want to be sharp? Why wouldn't you want to know all this that you can and then some in a field of industry, again, that doesn't require you have to sit in somebody's university for 4+ years, 3+ years, 2+ years to learn this trade or this, this craft. All you got to do is open your smartphone, go pull up some data, go pull up some YouTube, go put up, get around other people that are doing the same thing and then sponge off that. Now, you anti-opportunity, you anti-people, right? I don't understand, right? Again, success is defined by the people around you, not necessarily, you feel like you built the bridge on your own. No, that's not success, right? That's actually lunacy, right? No, opportunity is, again, other people coming together, think tanking together, and then going applying that knowledge to go out there and get the bag, right? To go get that bag, right? Or to go innovate, to make the world a better, obviously, place to be able to kind of live under, so to speak. So again, a lot of this stuff, again, you guys already know this stuff, but we need perspective, right? We need perspective, right? We need, again, I repeat, we need perspective, right? And it's not only is it tantamount to our survival, but it's a necessity, because at some point, again, we need to be able to pass down some notable traits and skills to our future children, or to our current children, or our grandkids, or whatever the case. Again, we can't be leaving them heirloom pictures and cooking pots and brooms and again, book, buy or some good book. But I mean, y'all get my point. You gotta leave them a bag. You gotta be able to leave these kids a bag, right? Because it's again, it matters, right? Resources matter. That's a t-shirt. Right? Resources matter, right? And when you don't have none, whoa, whoa. Pump the brakes, right? Slam on the gas, whatever. whoa, we got some problems. Houston, we have a problem, right? So again, it just makes for, you know, scenario where we just like, man, you know, we don't want to mess around here. We don't want to get caught, unprepared, right? We don't want to get caught, out there spinning our wheels, so to speak, right? People say you don't get caught spinning your wheels and all that kind of stuff. That's true. Don't get caught out there spinning your wheels, right? It's just not worth it. It's just not worth it. All right. Knowing again what we have, now as investors, as a trader, as a scenario where we can utilize it, a skill set that can help our bottom line at any given moment. At any given moment, right? Got my neighbor out there. He's getting the yard. He must be cutting his yard. I keep stretching that little weed trimmer to the limit. Or that sound like that. It's like it's crying. You need to let off on that gas throttle, neighbor. Whatever. Just cutting up a little bit, having fun. But anyway, guys. So that's it, guys. So you guys get it. I just want to come on. I try to, bring some perspective. I try to bring some substance. I try to bring, some different viewpoints, vantage points, whatever you want to call it, whether it be useful or may or may not. But again, I try to, allow us the opportunity to feed off some different viewpoints, right? Let us think. Again, we want to be critical thinkers, right? Again, y'all know I'm a big proponent of that. We need to be solid at learning how to be better critical thinkers. We have to be better critical thinkers. We have to realize that, it's problematic when we're not critical thinking. When we're moving on emotion alone, that's problematic. That's very problematic, right? We need to be able to assess properly. We need to be able to stop, focus, again, make it make sense, basically, right? And then go execute, right? After that, right? Right after that, go execute what we need to do, right? So again, don't lose, or don't give up on your ability to be able to be sharp and proficient, right? To be, the intellectual person that you really are. And at a point in the time when people don't necessarily want to give you credit for what you really, for how, for the value that you possess. Again, people always trying to define you and put you in the box and this, that, and the third. I understand, right? They don't understand. That's all it is, right? But again, as long as you know your worth and what you're capable of, the rest is history. All right, the rest is history. The rest is history, right? Do not let, again, people define your value and your worth, right? If they can't help complement it, then again, don't waste your time around. And I'm saying that because again, as an investor, as a trader, people are gonna look at you crazy. People start trying to assess you, and they don't want to take you serious because they can't see themselves doing something. Again, that's just fear. That's fear and ignorance, and that's fine, right? Because again, as long as you quiet and you don't present yourself flat and whatever, they'll eventually see. Eventually, it'll start wearing off. They'll come back around and start asking questions. Hey, what is that stock market stuff again you was talking about? So what is this investment stuff you've been talking about? Man, I've been seeing you've been, man, you're doing pretty good over here. You're over here making moves, I see over here. Man, what's that stock market stuff again? So now let me come over here. Now let's go to work, right? Let's get out of that, that fear, right? Y'all know the acronym for fear, right? False evidence appearing real, right? Everybody walking around all this fear and don't respect the value. That is a lot of it, just a lot of mental. Right? Danger is one thing, fear is another. Danger is real. Fear is mental. That's all it is. It's mental. It's the same reason why, again, people get boxed in a certain perspective, because again, they allow fear to overtake them to the point where they just start owning that fear. They start owning that negative, rhetoric. They start owning that, well, you can't do this and you can't do that, and now what you're doing is this, that, and the third. Before you know, you're like, man, forget it. I'm through with it too. I don't want to do that. I'm like, what? I'm like, wait, what? No, don't give up on yourself. First thing you can do is give up on self. That's not even nature's first rule of nature is what? Self-preservation, right? Self-preservation is the first rule of nature, right? First law, whatever you want to call it. So I mean, preserve thyself, so to speak, right? Don't give up on yourself, right? You're all you got, basically. Y'all know all the little cliches and the sayings. So again, with that being said, Don't fight. No, don't go out there feel like you got to fight. Fight to get acknowledgement, so to speak. Don't go out there feel like you got to fight for people to realize who you are. Find opportunities out there in the world in a way where your action value will define your worth value. And one of those tools that we know we can utilize that doesn't require Mr. Charlie throwing a monkey wrench in our plans, right? Y'all know where I'm going with this? It's the stock market. I can have 30 felonies and still be able to trade the stock market. Make more money than the DA that prosecuted me. Make more money than the judge that hit the gavel and tried to sentence me. Make more than that old ratchet behind little police officer thought he had some power just because he can handcuff me. I make more money than the county clerk that thought she had some power on me because I got to go bring my ratchet ticket up to her and pay it off. And I make more. See what I'm saying? 100% right. That's what I'm talking about. Only way to the gun range right now. Right? Right? See what I'm saying? If they go unload on some SKs, right? No, it ain't true. No SK. All right, AR-15, right? Go open up a little bit. You know what I'm saying? Open up the 45 and 9. I don't know what you're going over to shoot, right? What you're going to go unload off of today. But again, that's what I'm talking about. That freedom value, right? Staying, again, in the fold. Staying protected. Staying, again, there's more than one way to, protect yourself, obviously. Right. But again, financial literacy to me is like, right. Financial literacy to me is pretty much like this should be like, it should be inherent. It should be innately a mental faculty of our lives in a way where it's like you cannot, the same way you got to breathe and walk and drink water and all this. Financial literacy should be just right at the top in that same little echelon of characteristics or element of age that we need. Meaning knowing how to utilize the power of using some financial knowledge or some value of knowledge to be able to take care of yourself, take care of your family, to take care of your friends, to take care of whatever. An opportunistic minded person, based like I said before. Again, not to have to kind of keep reiterating, but you get my point, right? So again, that's why it's behooving of us to stay in the books, stay studying, stay being around people who are who are super excited about growth, advancement, opportunity as a whole. Just I don't want to be locked into a particular bubble. Right, or into a particular frame of thought where I can't necessarily see myself having the life that I want to live on my terms, right? Because I have to wait on Mr. Charlie to cut the check. I got to wait on this, that, and the third. Y'all get it. It's like, no, I don't want to go through all that. I want to be able to do what I need to do to get what I want when I need it, so I can live the life I want to live. Right? Again, the market offers that. It offers that in a lot of different ways. It offers that in a lot of different ways. Right. So again, I just want to make sure I kind of keep reiterating that, man. It's just like, man, we have a lot of, a lot to be excited about, Right. We have a lot to be excited about. Right. And every day we wake up, just realize you don't need the people that in terms of these companies, that we got to clock into sometimes. Some of you guys out there, you don't need them as much as they need you. That should be your mindset, right? We don't need them as much as they need us, right? So that way you don't have to feel like you indebted to that or indebted to them, or you kind of, or that you won't be able to survive without them, so to speak. No, that's not true. That is not true, right? So again, as long as we know that, as long as we own that, as long as we honor that, then the rest, again, is history, pure history, guys. So I look forward to having many more sessions like this. Again, you guys know I just started my little thing with Retrade HQ over there, with the family. Start my little mentor with them now as well. I'm excited about that. Again, I'm just trying to do whatever I can to help. I still do my YouTube thing here, so it's not like I'm somewhere out of the loop where you can't find me, access me. I'm just one person. I'm nobody. but I do have a passion to help wherever I can. I do have a passion to want to share this knowledge, share this information, pay it forward because it makes me better. Simple as that, right? Why wouldn't I want everybody to be successful, in life, period, right? Simple. I mean, it's a simple thought process. Why wouldn't you want everybody to be successful? Well, we know that a lot of people out there don't think that way because they're too busy trying to hoard everything for themselves, right? Because they want attention, right? I'm like, I can care less about that. I can care less about the attention, right? I want the retention, the ability to retain, resources so I can help, my future or help others. And y'all get what I'm saying. So with that, you feel charged to want to, pay that information forward, pay that knowledge forward, so it can benefit others too, so it can help them in theirs or whatever the case. So, again, I'm excited for that. And I'm always happy to come in and, hang out with you guys, go live, whatever. Let's talk some real talk, right? Let's talk some real talk and let's go back it up by some data, right? We can go pull up the stats. We can go pull up, all the charts, this, that, and the third, the news, whatever. But as long as we can utilize it in a way where it'll benefit us, then, to me, that's a no-brainer. Right? It's no-brainer kind of information. All right. So again, I am going to get ready to go, grab me a late lunch here since I started late. Not too busy traders market, going crazy, watching all these stocks, run all over the place and drop and do this, that, and third. I need to grab me a little bite to eat here, right? Got me some quinoa going right now in the oven, some quinoa, some roasted vegetables, right? Whatever. I'm about to grab me a quick little bite to eat here. I will open up my screen. I have a few trades still going right now. Again, I'm having a good little day. I'll just say I'm having a good little day. Right? And I'm pretty sure everybody else is too, that understand how to trade this market with all this pulling back happening, buying the puts, buy whatever, you naked shorting. If you got some little plays out there that running along like Campbell Soup, obviously beat on earnings. Who would have thought, right? Only thought that was actually green pre-market of notable consent. All right, and it was running a little bit, but other than that, a lot of this market was pulling back, so a lot of stocks were being shorted heavily, being a lot of puts were bought. This, that, and third. Again, the market just turning over. Hand over fist again, getting pummeled. Obviously, like stocks like Apple. Again, still more punishment that they're having to deal with. Again, just as a whole, there's a lot of stuff out there. There's a lot of stocks out there that are still so-called quote unquote bleeding, bleeding from their earnings reports and this, that, and third that's causing their sector to kind of fade out. Apple being one of them. The tech sector as a whole, actually, but excuse me, either way, there's opportunity out there in the market if you're trading it properly. Right, a lot of stocks still pulling back heavily. A lot of them are still pulling back heavily here. All right, so again, I'm excited for that. For just to be an opportunity where we can trade this stuff. It's exciting. All right, so again, yeah, we'll let CNBC, walk us into the commentary, going into the, the power hour of the market here. See what they're talking about. Again, they're over there in panic mode. Chicken Little's over there. The sky's falling. You already know what it is. Y'all already know what it is over there at CNBC. Right? They got to protect their little investors that that work underneath their portfolios or whatever the case. So and that's pretty much how it is. All right, that's the business of the day. All right, they go Apple. Apple going lower. Look at Apple. Ooh, Apple still looking good here. Apple finna break this key level of support here, man. I covered off my big short on Apple a few days ago. I should have left a little bit in there, though. Something told me to, but that was like, oh man, I don't even want to talk about that one. Crushed Apple. Same way I crushed NVIDIA short in the earnings. Crushed it. Right? So again, I get excited about that stuff, but y'all know me. Anyway, guys, I'm gonna share my screen here, guys. I'm gonna get up and go grab me a little lunch here. Again, power and profit to you guys, power and profit to my family, power and profit to you guys, all you guys, man. You guys are awesome. Again, I enjoy our think tank. I enjoy our moment to come together and expound on knowledge. Right? I know what it does for us. Right? Hey, good to see you, family. 62H Town, 626H Town in the house. Good to see you, family. Right? Good to see you, family. Power and profit to anybody I may have forgotten. If I didn't say Mac Tip in the house, good to see you, family. Power and profit to you guys. Power and profit. Right? Good to see you guys. All right. So let me share my screen, grab me a little bite to eat here, guys, and I'll be back on in the power hour. Within that time frame. I'm pretty sure you guys still trading or watching the market, whatever the case, but. Again, if you trade or not trading, I'll definitely share a little bit of my screen with you, kind of see what the market is doing. And, again, we kind of make sense of this stuff. And I'll be back on here and, shortly again. with a little commentary probably back in the day. We got some earning plays dropping this afternoon as well after the bell. Some of them are kind of notable as well. We have some good ones today as it is, and yesterday. So there still may be some opportunity out there in the market that we can capitalize on. There goes NVS starting to roll over again from the 87 mark. Right, it's still trying to find out what it's going to do. If it's going to bull flag them off this bottom of 86.24, if it's going to roll over back down there and test that lower day possibly off that news. We'll see here. Either way, again, the market is very giving if you just know how to trade it properly. Right, if you learn how to trade it properly, you can get to the bag. Right, it's exciting. All right, so again, let me share my screen and I'll be back here in a minute, guys. There go L brand. There go LB. Ooh. All right, we cracked this 29. We might see that lower day breach. I still got some puts left in LB. I sold a couple. I got left, a couple of them that still left. All right, I shorted that one in the earnings. Y'all see the end result. JD, I'm still holding some of my JD puts. I shorted JD in the earnings as well. Right, still eating up that little stock. All right, so again, I mean, this stuff, hey, family, as they say, family. Nibble off this one here a little bit small share side. Let me test it here, this little area. All right, so hold up, make sure CNBC is up.
The items the world has to offer.
Okay, awesome.
When you rent a car on Turo.
All right, there you go, LB. Go and break that low of day. Same with you, JD. Break that low of day. Well, we need this to break at least 29 to get back to the low of day, but either way, look at Apple. Apple going lower. Apple still dumping. It's gonna bring down the spot too. It's gonna bring the spot down lower. Man, this money, all this money being made right now, guys. Golly.
It's up 104% year to date.
Man,
this today's mystery chart.
Hush up and just share my screen.
Canada Goose. Lower.
I'll be back in a minute, guys.
But it is up more than 27% in just 1 month. Contessa Brewer's live at the company's flagship store in Manhattan with more. Hi, Contessa.
Hi there, Melissa. You know who is actually gearing up for a gangbusters holiday season?
Me.
It's Canada Goose. Look at the line. Right now, more than 35 minutes
and
long.
You guys.
People are
we can't wait to get up to some of these stocks.
A gaggle of customers, so to speak, waiting to fuck down $1,000 more or less on a warm coat. And the company has just announced earnings last week, up 34% over the previous quarter. They've raised 2019 guidance, now saying they expect annual revenue growth of 30% versus the previously anticipated 20%. And in line, the majority of customers are Asian. Do you think that there's some concern here about the Chinese economy slowing? Nope. They say the coats are priced just right. Listen to this.
Everyone have the Canada Goose, so I want to try and can if suitable for me. I saw the jacket; it's very nice, and I need a warm jacket for at home.
A lot of movie stars wear it, and I think that advertisement is also pretty good. Canada Goose, it's pretty popular in China. People all want to wear it because it's so warm.
The company is opening 5 stores in China and says it has no concerns about cannibalizing the tourist shopping in Canada or the United States. Analysts say in part this is because they offer such an amazing intersection of fashion and performance. And just a note here, on the weekends, they say the line can stretch down the block, maybe 3.5 hours, because in part, inside every person, every customer group is paired with a brand manager, someone who can help them pick out and try on coats. It takes a lot of staff to do that, and they say, maybe they don't have enough people to deal with all of this line. Guys?
Contessa, they're obviously in demand, but last year they had some pipeline issues where some of their distribution partners didn't have the inventory that they needed. Have they solved that problem for this year's holiday season?
She says that they have, the CEO said on the earnings call, look, we have plenty of products online. We're looking forward to getting this to our retail partners and to our shops. But she says she thinks that this whole idea that you're sold out as a problem is way overblown. She says, look, for the brand, being sold out might actually be a good thing. So she doesn't see that that's a problem.
All right, Contessa, thank you very much. Going to need it on Thanksgiving, I think, because it's supposed to be, 28 degrees here.
High for the high.
Cold for the high. Coldest Thanksgiving in 100 years or so. Let's stick with retail now, which is joining the sell-off today. Target slumping, mixed results there. Kohl's, TJX, Lowe's, all slumping. Disappointing guidance. and these companies turn it around with a strong holiday season. I want to get my wife some nice lumber for Christmas from Lowe's. I think that's going to go over well, right?
Prices are down on
Jan Niffen, CEO of J. Rogers Niffen, and WWE.
Show it with your wife with some bag of
Wrestling,
lumber you want, bro.
and a
You sleep on the
CNBC
couch.
contributor. Jan, good to have you here. Let's talk about Canada Goose.
That's not
you
a
love
downer,
it?
is it?
Oh,
I see what you did
do. You love it? Do you think that it's too late to buy into a stock that's gone up that much, or do they still have their mojo?
No, I actually love it because the fat is still there and the scarcity factor is still there, as we just talked about. And as long as you've got that going, it all keeps working. So will there be a day when it's just another jacket? I guess it will be, but it's going to be a while. So I think it's pretty safe right now.
There goes the L brand.
I understand
keep working,
the investing game of the trading game that says, when a company comes out with profits that are 40% higher, but they don't forecast or they don't raise their estimate enough, and they have some issue there that the stock's going to get punished. But do these stocks deserve to be punished as badly as they're being punished today for what could be called sort of minor nitpicks?
Come on, does the market deserve what it's getting today? Retailers released good earnings, they were down 10%. They released bad earnings, they were down 20%. So no, they don't deserve it. The retailers are actually doing a pretty good job. Even when you look at somebody like Target that just put out the release, right? People didn't like it. They thought they were reinvesting too much or the expense structure was too high. Come on, they were up 50% online. Isn't that what we want all of them to do, grow online? You grow online, you're going to have some expense pressure against your gross margin because you're doing things. That's a problem throughout the group, right? Whether you're Macy's or whether you're Walmart or whether you're Target, you're having some expenses go up because of all the great online business you're doing, but that's what you have to do to grow. So I say all the time to my clients, the ROI may not be as strong as it's been in the past, but these are guys who are going to be the winners. They're still going to be around. They're going to be able to pay a dividend and buy back stock, and they're continuing to grow, and they're getting good growth online.
You're loving Kohl's, or you have been, but today it's getting hammered.
Yeah, I still love Kohl's.
Yeah.
My favorites are still Nordstrom's, Macy's, Kohl's, and Walmart from the point of view of big, old, traditional retailers that are maximum taxpayers, low leverage, reinvesting in the business, making it all work, giving the customer new and innovative things. And you're not seeing much of that in traditional retail. All four of them are. So yes, I still like Kohl's. I think they're doing a really good job with their customer interface.
Does good consumer sentiment right now and a stronger consumer wallet mean that niche luxury brands like a Canada Goose are poised to benefit this holiday season? Is it the Montclair owners out there? Are these luxury brands ones that stand to really benefit?
Well, they certainly were until today. Now, if the market crashes down around our ears, there's unfortunately a really strong correlation between the S&P 500's performance in the fourth quarter in retail sales, and it's more so at the upper end than across the board. And that's not my work, that's ISI's work, but I believe them. So the only problem I can find to look at right now is the stock market. Earnings are pretty darn good. Everybody's working. Wages are rising. More people are having jobs than are looking for jobs.
The market's looking forward 6 months to a year, and they're expecting some sort of a slowdown when it comes to the consumer as well as the economy. So is it right, perhaps, for retailers to start pricing that in as well, just like the broader stock market?
Come down, Spy.
Sure, if in fact we're going to see that
break low of day
across the board, right?
Apple kind of help me out. Come on, Apple, keep dumping.
Second quarter,
come on, L brands, keep dumping. Come on, Target, keep dumping.
You want to look out. At some point, the tax law effects start to slow down, and we'll start to see that in the business. But we'll see record refunds in first and second quarter.
Right.
The consumer will spend that. I think we'll see a strong fourth quarter, a strong first quarter, and a strong second quarter. I'm a little worried about the upper end as all of us in blue states figure out that our salt's not deductible, and we have to pay more in taxes. But the rest of retail should look really good for the next 3 quarters.
Can we get a close shot of Mr. Niffen here with his wonderful tie and this very, very elegant double-breasted jacket? I'm going to channel my red carpet interviewer. Who are you wearing, Jan?
Unfortunately, I'm wearing Brooks Brothers, and they should be really proud. And I'd throw my foot on the counter because I'm wearing Lucchese boots. Maybe they'd be happy with that too.
All right, we got to leave it there. Jan Niffen, thanks.
All right, thanks very much. Well, markets right now moving towards just off their lows of the session right now. The Dow off by about 2.25%, 566 points. The Nasdaq down by almost 2%. The S&P off by that similar percentage amount. And the Russell 2000 small caps were outperforming. Now they're joining the downside party, off by nearly 2% as well. Power Lunch is back after this break.
Read it carefully.
All right, folks, the S&P, NASDAQ, and NASDAQ 100, Russell 2000 moving down towards correction territory, off by 10% plus from its recent highs. The Dow less than 1% from that correction level, as well as you can see there, we are off by about 532 points. It's been stable, guys.
It has.
We've been down about 450 to 550 for the better part of a couple hours at this stage.
We've had some minor blips. We had most notably an attempt by Amazon as well as Facebook to trade in the green for some period of time.
And Facebook did.
And Facebook did by more than 1%.
Yes.
But both of those stocks failed back in the red. And I think that speaks volumes about this.
About where we're going right now.
Exactly. Right. Thanks for being with us, Don.
It's always a pleasure
to have you here.
Thanks for watching Power.
And closing bell starts right now.
Good afternoon and warm welcome to the closing bell. I'm Wilfred Frost.
I'm Sarah Eisen in for Kelly Evans.
Good to have you back, Sarah.
Good to be back. So for the market, it looks like it's gone from bad to worse over the week and the session.
I know, but maybe you can bring some steadiness in this final hour of trade, Sarah. We shall see. Jim Cramer has been tweeting he's wants to rally, but he doesn't want it to start till 2:45, and he wants it to be slow and steady.
All right,
it does
3
start.
p.m. Let's go.
It's 3 p.m. Well, exactly. Sorry, I meant 3:45, he said, with 15 minutes left to trade. Let's get to the market action, which, as we have said, is lower. Stocks plunging. The Dow dropping nearly 600 points, 596 at the low of the day. It is currently down 533, over 2%. S&P and NASDAQ down less than 2%.
So energy is the biggest loser right now, but technology continues to get slammed. The NASDAQ is on pace for its lowest close since April. It's down 15% from that record high that had hit not too long ago, inching closer to bear market territory. That would be 20% off the high, and raising some real recession concerns. Let's get right to our reporters on the sell-off. Seema Modi is here at the NYSE. Dom Chu is looking at those ravaged tech stocks. Bertha Coombs has more on the NASDAQ's rough session. And Steve Leisman is analyzing those concerns about a recession. Seema, let's start with you in the action here on the floor.
Down about 502, Sarah. What started as a tech-driven sell-off has now spread to retailers and energy. Let's start with the retail. Report cards from a number of big retailers, from Target to Lowe's, echoing those concerns around a slowdown in consumer spending. And then there's this report from Goldman Sachs. It's 2019 forecast. They're expecting a single-digit return for the S&P 500 next year, a shift to higher quality companies, and for the first time in many years, analysts there expect cash to become more appealing to investors. This sort of lends support to this rotation that we've already seen play out in the past month. Take a look at how healthcare utilities have fared in comparison to the S&P 500. It's done pretty well. With this market volatility on the rise, it is worth noting that earnings estimates have come down. When earnings season kicked off in mid-October, analysts were expecting fourth quarter earnings to jump 20%. That's fallen to 17.3%. For Q1, it's down to 7% from 8%. Back to today's sell-off, though, yes, it's retail, energy, technology, but even financials have joined in just as rates tick lower. And guys, we're keeping a very close eye on the VIX, back above 23. Wolf.
Seema, and I guess it's not just the US today. I think every single major international equity indice, Asia and Europe included, down today.
That's a very good point. Unlike yesterday, the global markets did sell off overnight, so we started the tape lower, and that, of course, accentuated the loss here in the United States. Tomorrow, we're looking to politics. The EU is expected to respond to Italy's draft budget, and later this week, we have the Purchasing Managers Index out of Europe, and as you know, that is an economic data point that investors watch very closely.
They do indeed. Seema, thank you very much for that. Now, FANG stocks have been a big driver of the market downturn, losing hundreds of billions of dollars in market cap from their recent highs. Dom Chu back at HQ with more. Hi, Dom.
Hey, so Wilfred, Sarah, as we talk about the market action so far, we've tried to update this as in real time as possible. But let's take a look at those FANG stocks plus Apple, the FANG, if you want to look at them that way. They are in focus for a lot of traders because they have been arguably the upside drivers, the momentum stocks to the upside. And right now, since each stock's respective high, they've lost umpteen billions of dollars of market cap. Facebook, since its record highs back on July 25th, $250 billion lost. That's roughly the size of Verizon, to put it in perspective there. Amazon, $260 billion to the downside and lost market cap since September 4th. Apple, $263 billion since its record high on October 3rd, $156 billion for Google parent company Alphabet since July 27th, and even Netflix, a smaller company than those four previous, but it still lost about $64 billion worth of market value since highs back on June 21st. Now, all told, as of a few moments ago, that brings the total market cap lost for these FANG stocks plus Apple to around $995 billion. We're going to call it roughly $1 trillion in lost market cap. For that reason, it is just about the market value lost being just about the size of what Apple was worth towards the peak of its market cap. So it's certainly something to keep an eye on, guys. That FANG stock in focus for many traders out there. Back over to you guys.
And it looks like in terms of the biggest percentage losers off their highs, it's actually the chip stocks, Dom, as you say, NVIDIA, Micron, AMD, 50% or more off their highs.
Yeah, and it's not just that. They've been viewed, those semiconductors, Sarah, as you know, as one of the leading indicators to the downside. They've moved lower much earlier than many other parts of the market. So as we've talked about stocks like NVIDIA or Advanced Micro Devices or even Micron to the upside, they have been among the hardest hit during this downturn. So yes, those chip stocks, certainly a sentiment gauge, a tea leaf, a big one out there for many traders. If they can turn around, perhaps there's some hope for the overall market. But for right now, that sentiment for chips, certainly to the downside, Sarah.
Yeah, there was some pockets of strength today. NVIDIA's up 2.5%. Dom, thank you. By the way, we are seeing session lows. The Dow is now down 607 points. Here we go into the close. Let's take a broader look at the tech sector, though, as the NASDAQ plunges deeper into correction territory. Bertha Coombs is uptown at the NASDAQ. On what's driving the declines, at 2% lowered, Bertha.
It is pretty much tech, Sarah. You know, the NASDAQ composite hasn't closed below 7,000 since April 3rd. With today's decline, it is now flat for the year. It looked like it was just
That's right. Come on, keep rolling over target.
Year to date this morning, fractionally, and well into correction territory. And a lot of that, as you look at it, is led by big cap tech.
Look at Apple. Ooh, Apple dumping. Ooh, look at Apple dumping.
How far they've fallen from their highs, how
Wow,
Bear
look at this market
the
go.
big FANG momentum names, which includes not just the Facebook,
Wow.
Apple, and Amazon, and Alphabet, but
LB
also
from the hit low of day,
NVIDIA and some of the others.
break low of day.
And they're down 24% from highs. And the chip sector, which fell
same way with JD. JD already broke low of day.
Above its March lows, but it has been really that
Wow.
sentiment, a bearish sentiment that has really permeated now.
Exactly why I put up this meme here, or this little train wreck here. This is the market today. It's been the market for a minute here, but that's the market
really
there.
Demonstrates
Train
the
wreck.
skepticism that still remains about buying into this
Stocks going off on the scanner.
It was higher this
What's
morning,
going on?
and you've just seen a fade of that rally as we've gone further into the afternoon. That said, chip names are leading the Nasdaq at this hour. Applied
Still got some puts in GE.
Both on very strong volume, much
stronger
than
GE up over the past
NVIDIA,
2 weeks.
Reversing from an 18-month low this morning.
I've been tearing the video. I mean, NVIDIA. That too, but GE up.
Had an attractive valuation today and started to buy. Still,
top decliners. I mean, look at that list of top decliners. Look at all them stocks at the top decliners today.
In fact,
all these are top decliners. They're just some of them, not all of them, but the gainers list, it ain't even that.
Okay, Buster, I'll pick it up. Thank you very much.
It's thin, but you got some winners today, a little bit over there.
Shows a growing concern among economists about a recession.
And it just got a little boost, so whatever it's doing, it's squeezing up right now.
2 years has ticked higher.
ANY.
35% up.
Yeah, nice little squeeze up on ANY. From $4 up to like $4.98 and going higher. Nice. We must have dropped some news on ANY. Nice squeeze up.
October 19th, 1987 stands as one of the darkest days.
Nice. Let's see if it break out above 5 here.
A 20%
or if it just rolls back.
Serves a lesson for
big resistance at $5 so far.
There's another lesson. How big market downdrafts may not necessarily correctly signal recessions. In fact, as this chart shows, it wouldn't be for another 3 years after the 87 crash that the economy would enter recession, probably not even connected to the downdraft. Numerous other
recession talk
declines didn't presage economic downturns, and somewhere they did. That leads to the common economist joke out there. The stock market has correctly predicted 9 of the last 5 recessions. Respondents to the most recent CNBC Fed survey that's different from Reuters. They put the chance of recession at around 19%. You can see that's higher than it's been, but about average for the series. So a little bit higher. Right now, forecasts call for slowing growth, but not necessarily slow growth. Most Fed officials and Wall Street economists see the economy coming down to around trend growth of 2%. And the unemployment rate continuing to fall, maybe even to 3%. There's one problem. More folks do see the fate of the economy tied to stocks. Take a look at our All-America survey. We asked this question in 2013, and we asked it recently here. You can see that 38% say when the Dow hits a record, it means the economy is doing better.
About $5 resistance.
In 2013, just 22% thought that, whereas 46% say it shows the firms and the companies and the wealthy are doing better.
There you go.
Are not sure. Now, the clip about the market predicting 9 of the past 5 recessions.
Big resistance up there. Short sellers up there shorting.
Economist Paul Samuelson. He wrote it in Newsweek. In 2016, I went back to see if he was right. Turns out he was ever so slightly off. There have been 13 bear markets in the post-war era. They have predicted 7 recessions within 12 months. So, guys, just slightly better than a coin flip. Well.
And Steve, just quickly, the economic data itself in the last month or 2 months, as the markets turned down, has not pointed any more to a recession.
I'll tell you where it's pointed us. It's pointed us to a third quarter, did 3.6 or so, and the current best CNBC Rapid update is 2.8. But remember, trend is 2%. So, yeah, we came down 4.2, 3.6, and now we're going to do 2.6, but we're still better than half a point above what's thought to be potential growth in the economy.
Steve, thank you very much for that. Meantime, the market's down 613 points, session lows 2.4% on the Dow. Talk of recession, given the market downturn, caught the attention of the White House today, with economic advisor Larry Kudlow telling reporters, including CNBC's Eamon Javers, quote, "I'm reading some of the weirdest stuff, how a recession is in the future. Nonsense." Well, is it nonsense? Let's discuss with Jeremy Siegel, professor at the University of Pennsylvania.
He had to say that because he's a right-hand man, Trump.
CBS. Very good afternoon.
But have nothing less from this dictator kind of way of governing.
Is Mr. Kudlow right to pour scorn on the idea that a recession is not in sight?
It's not in sight. That's true. And by the way, Samuelson's quotation was 50 years ago, and he was right about 9 out of 5. And Steve Leisman was right. It's almost, we've had 3 or 4 recessions since then, yet about 7 or 8 bear markets. So it's certainly no certainty that even a bear market predicts a recession. However, the market is clearly worried about over tightening of the Fed, and I expect Chairman Powell to either make a speech or indicate in the next FOMC meeting that the Fed is going to substantially slow down its rate of rate hikes in 2019. I think that
of course, that's what you would
something.
like to happen.
Saying that the pace
that's
is
what you're
just
advocating
a
to
little too
happen.
fast. It's not strong enough to take a 3.5% Fed funds rate or higher next year.
Jason, do you agree? I assume you don't
Doesn't
predict
account
any
for all the
kind of
money that people
recession
did
because
made
you don't
up this
really want
last
to
year.
Yeah, we don't think a recession is likely in the next 12 months at all. I think the probability is it's actually lower than normal. It's true when you go into 2020, the probability rises, but that's kind of getting back to sort of like a long-term normal average. I think another thing that's important to look at when you think about the relationship between the stock market and the economy, the annual correlation between like annual GDP growth and stock market performance is close to zero. So you can have years where growth is really good and markets underperform and vice versa. So the fact that the markets might be pulling back in a year where growth is actually good, that's almost sort of historical norm. You don't have a great relationship between the two. But when we look forward, think about this morning with the retail sales numbers that came out, market didn't like it, but top line growth looks good. Sales for Christmas season look like they'll be up 5%. Maybe the earnings aren't going to be quite as good, but at a high level, the economy is doing well. So it's hard to kind of look at how the market's performing and think this is telling us too much about how the economy is going to do over the next 12 months.
Jason, do you buy or sell US Treasury bonds at the moment? Some people seemingly suggest that they think rates have peaked for the medium term at least.
So it depends obviously what part of the curve you're talking about. If we think like 10-year or sort of longer duration, we think they're going to be trading in a range of where they've been recently. So on the 10-year Treasury, from like around 3 to 3.3%. So we're kind of at the lower end of the range. So perhaps buying and adding duration exposure at this point in time, we're kind of getting a little tight. As a structural component of your portfolio, though, I think having some longer duration in general is good at this stage in the cycle. Because if we do get a more material slowdown, if we're kind of wrong about our growth, then you're going to see rates come down. As Jeremy alluded to, the Fed will probably dial back expectations. Then you get a rate fall. And whatever you lose on equities, at least the fixed income component, if it's longer duration, gives you some of the protection in your portfolio.
So, Jeremy, it sounds like you see the Fed, taking a pause, reacting to the current market volatility and slowing down a bit. And then what? Then does the market rally? You think that's going to be good enough?
Well, first of all, we have a month almost. It's December 19th is the meeting. There's a lot of data coming in. But, we do see a sign of slowdown. Look at the sharp decline in oil prices, in commodity prices. My prediction is the PCE deflator, which is the price index the Fed uses to judge inflation, is going to drop below its 2% level in the next announcement at the end of this month. It might actually drop as low as 1.8. I think that's going to give ammunition to the doves out there to say, hey, guys, let's not overdo it. There's a lot of wobbly. Look at the international situation, and that was shocking. Negative growth for Germany, negative growth for Japan. We don't want to overdo it when there's no inflation whatsoever on the commodity or price front. And I think that's going to resonate at the meeting with Powell. And if he does say something before or afterwards, that's going to give the market, I think, a lot of relief.
We will see if all of that happens. Thanks for joining us on the economic signals out of this market. Jeremy Siegel and Jason Draho. During our closing bell exchange for the day, let's talk about all this action. Michael Yoshikami, the founder and CEO of Destination Wealth Management. Keith Bliss is here at the NYSE, Senior Vice President of Catone and Company. And Rick Santelli joining us from the CME Group in Chicago. Keith, we got to pause and take a look at the price of oil. WTI down 7% right now, or $4. Breaking below $53 a barrel at a 12-month low. What's that telling you?
Well, listening to Dr. Siegel and listening to Jason, I think the story is a little bit more complicated than looking at all of these things in their own current vacuum. But clearly the market is signaling that they're a little concerned about global growth. And I think that's a knock-on effect. First, we start with trade tensions between the U.S. and China, and that's going to have some impact not only on U.S. companies, but also on China's ability to hit their 6.5% target. And that will have downstream effects throughout the European Union and to other trading partners. And with that, the market is signaling, okay, I've got a slowdown in global growth. I do have an oversupply in oil that's still coming out. American producers are pumping as much as they can.
because their economics and their cost basis has come down substantially over the years, where they can still pump at $55 a barrel and make money. So we have a glut of oil on the market. We have a slowdown at the same time. The market is reading that, maybe conflating the two a little bit, that we have this massive global slowdown going on because oil is pulled in. We have both very oversold at this point in time, and I would expect WTI to trade back up to around the mid-60 level and Brent at the mid-70 level, at least in the short term. So, but we need to catch a bid throughout this market. We're really getting washed out in several areas. Equities, I actually have bonds overbought at this point in time. I think they'll start to come in a little bit, and commodities, and the dollar is still rallying, which is a negative for U.S. equities when you look at it.
Rick, for a day in which we've seen, or 2 days in which we've seen huge moves in U.S. equities, also today big moves in Italian debt, do you think that the U.S. debt market's been sort of remarkably stable?
Remarkably stable, Wolf. You nailed it. Listen, I understand what's going on in high yield. I understand all the issues with the credit spreads and the ETFs, HYG, LQD. But at the end of the day, consider this. This looks to be the 6th session in a row that the 10-year note yield's closing with a lower yield, higher price. And throughout those 6 sessions, and the furthest back one was basically the day we made the high yield close around 323.5, we're only down about 20 basis points. Now, I'm not saying 20 basis points isn't a lot, but in the context of how much stocks move, yes, I'm quite impressed by that. Take it a step farther. I understand all the agita about the Federal Reserve, but once again, I have to throw this out there. We have negative interest rates in Europe all the way out to the 7-year maturity, in Japan all the way out to the 8-year maturity. Should any of these economists actually hit a pitch thrown at them and there is a recession, truly, they should be high-fiving our Fed, because they will have room to go the other way and ease back. What's Europe going to do? What's Japan going to do? Now, to even more specifically answer your question, look at the relationships of the economies and the stock market. We're basically now unchanged or down a little bit for the year. But look at it as a spread. Our equity markets and economy versus Europe's, versus Japan, versus China. Yes, we've come down, but so have they. Divergence is taking a toll, and I understand that. But all things considered, it is remarkable that we're above 3%, in my opinion, still on a 10-year.
So given all of that, Michael, as a portfolio manager, what do you do? Are you fearful? Are you taking the opportunity to buy? Tell us about some of the moves you're making.
Well, first of all, I agree that
sit on your hands.
Are likely in a range right now. I think the concerns that the interest rate levels are going to raise to 3.4, 3.5. I saw a headline a couple weeks ago they were going to 4. I just don't think they're reasonable, and I completely agree that the Fed has been raising rates in some respects to have some room to go back the other way if there is a recession. So I wouldn't be selling fixed income at this point. I still wouldn't be out there buying long-dated bonds. We're not traders. We're long-term investors. But I think if you're intermediate, 3, 4, 5-year intermediate bonds, or maybe more close to 4, I think you're going to be okay. As far as technology, I'd be cautious on technology right now. Just because something's down 20% doesn't mean it can't go down 40%, as some of the chip stocks have proven. And then lastly, I would say that this might be the moment when finally there's some sort of rotation occurring, where we're actually starting to see dividend, more so-called boring names be more attractive than momentum names. You know, momentum is great when markets are rising.
Verizon.
When they're not rising, they can be ugly. And I think people
McDonald's.
tend to flee to more conservative dividend-oriented names, and I think you're starting to see that happen.
Keith, the biggest single factor that would get markets back on track again, is it trade or one of the others that we've talked about?
Well, if we get some clarity at the G20 meeting, I mean, they were trading barbs this last weekend as well, and that's always been a problem. If we get some clarity there, and then we have to get a bid in the FANG stocks. There's no two ways about it. I mean, they really have been the linchpin here. And the last thing I would point out is financials need to catch a bid here. If you look at some of the bigger names that are selling off, like Goldman Sachs, I mean, that's having a real impact on the Dow. A very high price stock, a dollar-weighted index, a price-weighted index rather, and that's selling off. Financials need to come back as well.
Yeah, second or third worst performing sector today. Guys, we'll leave it there. Thank you very much, Michael Yoshikami, Keith Bliss, and Rick Santelli.
Let's just give you a check of where we stand. 40 minutes until the closing bell, and we are right near session lows. The Dow has come off that minus 600 number. It's still down 2.25%. Minus 556 points right now. The Nasdaq Composite down 1.75%. It looked a lot worse earlier today. The Nasdaq at one point was down 2.8%. Still a broad and painful sell-off for investors today. In the S&P 500, down almost 2%. All sectors are lower. The hardest hit right now is energy, down 3.6%. Crude oil, down 7%. Technology, though, not far behind. Again, Wilfred bearing the brunt of the sell-off here.
Let's continue this market discussion. Joining us on the phone to talk more on the sell-off, Mohamed El-Arian, Chief Economic Advisor at Allianz. Mohamed, good afternoon to you. Thank you for joining us.
Thank you, Wilfred.
Now, of our many educated guests, Mohamed, you've been one of the more bullish ones on U.S. growth over the last 5 months or so in the next year or two. Are you still bullish about U.S. growth?
I am. I think what we're seeing in the market is not about growth in the U.S. It's about a transition, a long overdue transition away from ample and predictable liquidity to a more uncertain economic and liquidity regime. And the reason why it's so bumpy is not because U.S. growth is a problem. It's because the rest of the world is lagging in terms of pro-growth policies.
But if it's about the rest of the world, Mohamed,
tariffs,
why now?
trade
I mean,
war,
it was no secret that the rest of the world was
Brexit.
growing pretty much all year long, and the Chinese market, before the U.S. even stumbled, was down 20%.
You know, the image I always have when you see these violent sell-offs and these spikes in volatility is a mound of sand. You know, you can keep on putting new sand on top, but at some point the shape of the hill changes completely. And that's what's happening. I mean, we've just had a whole series of issues that have really focused concern on growth in the rest of the world.
So, Mohamed, if it's liquidity, then clearly central banks are a big factor in the concern for markets. Could they change their direction and do so quickly enough or severely enough that the equities can rally significantly again from here?
Could they? Sure. Will they? I'm not so sure. You know, I said from right in the beginning of the year that 3 hikes are enough for this year. We may still end up with 4. And it's very hard for the Fed to change track at this point. It has signaled very consistently. It has stopped trying to calm markets down. Its dual objectives are still pointing to another increase. It can't see any spillbacks from the rest of the world on the U.S. as yet. And then there's a political angle. So when I bring all that together, could the central banks change signals? Yes. Are they likely to? I'm not so sure.
Why? I mean, inflation. Jeremy Siegel just said he expects inflation to slow. We're starting to really see that in the commodities prices. So wouldn't that give them a little bit of cover?
You see it in commodities, but remember, they look through oil prices. Don't forget the wage. I mean, people have forgotten the wage number we got a few weeks ago, and it's going to be interesting to see what the next wage number looks like, but it wouldn't surprise me if we stay above 3% on wage growth. So no, I mean, it's not clear that inflation is not very near or at that target. So it's not clear to me that when they look at their dual objectives, when they look at spillback evidence, that they may think we don't want to change signals just yet.
In terms of this question of liquidity, Mohamed, how much impact are some of the foreign central banks having on the reduction in liquidity? Which ones in particular, and might any of them change direction?
Yeah, I mean, the ECB is still on course to stop its QE program at the end of the year. That's going to have an impact. You mentioned earlier in the show what's been happening to Italian debt. People are starting to realize that it matters when a central bank with an unlimited balance sheet decides not to buy your debt. And I think that what you're seeing is a cumulative effect of what's happening in the U.S., which is QT tightening, plus the rate hikes, plus what's happening in Europe. They've been tapering their QE for a while now. So yes, it's all coming together. And you know, but
ECB, Mario and Draghi, and European Fed, so to speak.
About this because we needed that transition. We've come from a very artificial period where everything was going up. And we need to go back to a more normal period. So long term, this is good for the health of the market. Short term, it's a very bumpy journey.
You know, I get your point that, you know, at some point we had to return to normal and it was going to be painful and it was going to be a place that we hadn't been before with the quantitative easing and the massive balance sheet. And maybe this is what a return to normal looks like, Mohamed. But if the Fed overdoes it on tightening, that can drag us into recession. I mean, history has shown that. And same with the markets. If it's the sell-off and the volatility continues, it can become a self-fulfilling prophecy. So I'm just wondering, what would make you think of that kind of extreme, that this wasn't maybe so healthy and normal and that it was more problematic?
So, Sarah, you're absolutely right. We are much more vulnerable to either a policy mistake or, and maybe a market accident. There's no doubt in my mind we are more vulnerable to both these things. And that's why it would have been better to start the normalization earlier, but it didn't come. So yes, we are more vulnerable. The key issue to look at is the strength of the U.S. economy and its strength overall and also relative to the others. Because it's not just that global growth as a whole is slowing down despite U.S. strength, it's becoming more divergent. And the biggest concern I have is that the rest of the world would drag us down. So look at the strength of the U.S. economy and hope that other countries get their act together when it comes to policies, which isn't the case as yet.
So let's talk about that a little bit more, Mohammed. Where in particular? Is this a China issue affected by trade? Is it a Europe issue affected by Brexit and Italy? And what is the chance? You said you're worried that they could drag U.S. growth down. What is it, 50-50 chance next year or lower?
So first, it's both China and Europe. In China, you're seeing a policy response, but unfortunately, they're going back to the old growth model. And that growth model is less potent. It's a little bit like cranking up a machine that's getting exhausted. So they haven't, while they're taking measures, they haven't taken the right measures as yet. Of course, the trade uncertainty is a headwind for them. In Europe, Italy, Brexit, Germany, what's going on with Hungary and Poland has diverted attention completely from productivity and competitiveness issues. So they need to sort out the political issues so that they can focus on the economic issues.
Back to the U.S. for a moment, because you said it all comes down to the U.S. economy, which looks pretty good, Mohammed. Then how do you read the softness we're seeing in the housing market? How do you read this kind of destruction we've seen in semiconductor stocks, which are often economic bellwethers, or a move like this in oil, which is now trading below $54 a barrel? Aren't those all economic signals?
So first, housing is cyclical, and it is the most cyclical along with automobiles. And when you're having a handoff from cyclical growth engines to secular growth engines, which is what the U.S. is in the middle of, your cyclical sectors aren't going to benefit. So for me, it's no surprise that housing and cars are doing badly. Second, there was overinvestment. There was way too much money that went to tech. And what we're seeing now is a normalization, if you like, of that sector. So, and then the third one, what was the third one again, Sarah? I'm sorry.
Third one, I was talking about oil prices, because right now they're down 7%.
Yeah, oil prices is three things that have come together, which is concerns about global growth, supply issue with the U.S. producing a lot. And today, the remarks from President Trump have taken away a political risk element associated with Saudi Arabia. So if you look at these, there are different reasons coming together. And the concern, and I share your concern, by the way, is that we may end up having various things come together and tip us over. I just don't think that's likely unless we get a policy mistake.
Okay, Mohammed, we will leave it there. Thank you very much for joining us. Mohammed El-Erian, the Allianz Chief Economic Advisor. We have just over 30 minutes left of trade, and we are trading significantly low, 2% on the Dow, 1.6% on the S&P, 1.6% on the NASDAQ. Seema Modi is here on the floor of the NYSE. Bertha Coombs is uptown at the NASDAQ with a summary for us with 30 minutes left to trade. Seema, let's start with you.
Hey, Wilfred. So it's a diverse set of stocks that are leading the Dow Industrials lower at this hour. Apple, Walgreens, Chevron, Goldman Sachs. Last week, we saw about a 5.5% drop in oil prices. We're lower today, and that's why energy has quickly become the worst performing sector across the board. Trade, though, is still getting a lot of attention ahead of that G20 meeting next week. Names like Boeing, Caterpillar, United Technologies, it doesn't seem like they're really moving on fundamentals. They're down again about 1 to 3%. Take a look at shares of Medtronic. Stock is actually moving higher on an earnings beat, even though that the medical device maker is feeling the effects of China tariffs. Its CEO telling Wall Street Journal that tariffs have put pressure on costs. But again, that stock bucking the downward trend. We'll get another feel on the pulse of the consumer. BJ Wholesale Foot Locker earnings at the bell. And then tomorrow, it's Deere, one of the big home builders. That stock down 11% so far this year. Sarah?
All right, Seema, thank you. Seema Modi. Let's send it uptown now to Bertha Coombs at the NASDAQ. Bertha, for the action there. Off the lows, but still pretty big selling.
We're off the lows, and yet we're still down when you look across the board in terms of sectors. Relative outperformers, chips and biotech, both have been positive this morning, both up about 1% in the morning. But those rallies just faded as we come into the afternoon. One of the things we're watching is whether some of those FANG stocks can move higher. Earlier this morning, we saw Facebook get some relative strength after hitting an 18-month low. It's back in the green here. Alphabet back in the green as well. But both of those stocks really technically very, very weak. They're in a death cross when their 50-day moving average is now below their 200-day moving average. Netflix has joined that as well. But it's not just tech here. Seema talked about some of the consumer names that are up reporting this afternoon. Ross's earnings this morning, relatively good, but the guidance for the all-important holiday quarter, not as robust as some would have liked, and it is a big loser here today, along with a number of other retail names. Apple, of course, the biggest drag, right now responsible for about 30% of both the NASDAQ and the S&P's decline so far this month. Guys, back to you.
Bertha, thank you very much for that. Time now for a CNBC News update with Tyler Matheson. Tyler.
Well, thank you very much. Aside from the markets, here is what's happening at this hour. Just days after hosting the Asia-Pacific Economic Cooperation meeting, the parliament in Papua New Guinea was the site of protests by security personnel. Disgruntled police officers and security guards broke windows, smashed furniture, tore pictures from the walls. According to lawmakers, the protests arose over a pay dispute. And 2 weeks after the November 6th election, Florida's election results are now final, certified. After tight margins prompted tumultuous recounts, Republican Rick Scott has been elected to the U.S. Senate, and Republican Ron DeSantis is the new Florida governor. Democrat Nikki Fried is the state agriculture commissioner. And Arlington, Texas hopes to make an impact in the growing market of esports by opening the largest gaming venue in the United States, 200,000 square feet. In an auditorium, it features gaming stations and an 85-foot LED video wall. And as you may know, the Los Angeles Rams beat the Kansas City Chiefs 54-51, the highest scoring game in Monday Night Football history, third highest ever in the NFL. But the biggest loser may have been the casinos. Sports books set the total points scored, the so-called over-under, at more or less than 64. And since the teams combined to score 105, everyone who bet the over, and that was roughly 70% of gamblers, according to one report, got paid. That's the CNBC News update at this hour. Back to you, folks. Well,
with plenty of room as well to spare with that particular bet. Tyler, thank you very much.
Thank you, sir.
Now, retail stocks getting hammered today after reporting various earnings coming out this morning. Let's bring in Courtney Reagan to summarize it all for us. Hi, Court.
It's been quite a busy day. Well, the retail sell-off, though, is about a couple things. First, it's the expense of fulfilling online orders. And then second, and maybe more acutely, it's fear that the good trends in retail are ending. So Target shares are down more than 10% after coming up short on earnings. Comp sales did miss slightly, but digital sales were almost 50%. Target's margins did fall because there's pressure from the cost of fulfilling all of those online orders and also from upping the holiday inventory because the retailer expects a strong season. Now, Lowe's comp sales and margins also disappointed, but analysts like that the new CEO, Marvin Ellison, is working on exiting non-core businesses and think the home improvement backdrop is still supportive for Lowe's going forward. Still, shares down 5%. And like Lowe's and Target, Kohl's margins also light, and it only raised the low end of its holiday quarter guidance. But earnings, revenue, and sales still beat for Kohl's. Still look at shares, down almost 9%. Now, on their company's respective media calls, I asked both Target CEO Brian Cornell and Best Buy CEO Hubert Joly if their view of U.S. consumer had changed. Cornell said, quote, "We see no change in the consumer environment." Joly said, quote, "Everything we are seeing about the consumer is very positive." But he did also acknowledge that economic cycles cannot last forever, and he knows that some think it is coming to an end. So investors are really worried that the best is behind us and that this retail turnaround that started last holiday season could be ending. So be careful. Let's watch out for Gap shares when it reports after the bell today. Specialty retail has really been a hit or miss area of the group. Sarah, back over to you.
All right, we will all be here for that. Courtney, thank you. In the next hour with Gap earnings. So do weaker than expected earnings results spell bad news for the retailers going into the all-important holiday season? Here to discuss what to do with the stocks, Patrick McKeever, president and founder of the Daily on Retail, and David Strasser is here as well, managing director at Swan and Legend Venture Partners. You heard David, Courtney just summarized the CEO's commentary, though. Brian Cornell saying that no change in the consumer spending, which last time he said was the best he's ever seen. Hubert Joly saying investors are too pessimistic. What's with the reactions in the stocks today?
Well, I bought some this morning. I just think that the reaction, it's a skittish market. These guys have been holding in relatively well to some of the other names.
So
Look, I think retailers are figuring out how to
They greedy because they think they're at the bottom.
They're doing it better.
They can't feel that they just go spend money on the market that's all that's selling off
on the margin side,
because their metric analysis value is skewed towards trying to so-called quote-unquote save the market. How can your little dollar save the market?
But they're getting better and better.
This ain't like a vote.
A year ago, this was the moment to buy retail.
You know, where your little ballot may be, this is money. People's money. Like, man, nobody got no.
I mean, there are some other moving parts right now. Valuations are a little different.
I don't know.
But
again,
I think this could end up being a buying moment right here.
Patrick, do you agree today?
They said that about a week ago. They said that 2 weeks ago. They said that a month ago.
Yeah, I agree with David on Target. I mean,
some of these stocks
is the big.
You just gotta let them,
in my opinion, it's
settle
probably
first.
the most important metric when you're looking at retailers. And Target's had 2 quarters now of 5% plus traffic. And the guidance for the fourth quarter is for roughly 5% comp, and presumably that will be traffic driven as well. And some of the initiatives that are driving that very strong traffic metric are still in their relative infancy, including some of the expanded fulfillment options through Shipt and Target Restock and some of those other initiatives. So I think we're actually relatively early on, and I think they can sustain this traffic momentum well into next year.
David, what else would you buy here?
Look, the home improvement guys are a little nerve-wracking to me because just housing seems to really be sputtering along. But I like, some of these names like Best Buy. There's a lot going on in that space. You still have the benefits from the weakness at Sears. Appliance sales continue to be helping drive that business. They're continuing to get better online. I like that. I like Kohl's, Target. I mean, there's ample opportunity out there, and on the specialty retail side, I think I think Courtney Reagan said it well. It's been hit or miss out there. Urban looked pretty good today. Look, it feels like there's a moment here, and I just think on a bigger picture, these retailers are getting better and better in this new environment, and the weaker guys are going away, and the stronger guys are really rising to the top.
Patrick, the difference in performance between consumer staples and consumer discretionary, not actually that large year to date. They're both sort of either side of the flat line, but discretionary's really fallen out of bed in the last sort of 3 months or so. So is that a buying opportunity for that subsector of the consumer space?
Yeah, I mean, I think so. I think it's been a bit of an overreaction. I know the market's really jittery right now for a few different reasons, but the consumer, barring some kind of a major, further plunge in the stock market, which certainly impacts consumer confidence and spending when consumers look at their 401ks and that sort of thing. But otherwise, the underpinnings of the consumer are still very healthy. I mean, we've heard that from a bunch of retailers, including Target, Brian Cornell, Courtney mentioned that. I think it's true. I think the consumer is in good shape right now. So I think that the plunge across the XRT being down double digits over the past week or so, yes, I think that's overdone.
All right, you heard it again here. Consumers in great shape, retail stocks not so much. Patrick McKeever and David Strasser. Thank you both, Wilfred. Talking about specialty retailer being hit or miss.
You're saying thank you to me there as well.
No.
Thank you both, Wilfred.
I want to point out to you, Wilfred, L Brands is down 17%. Talking about a miss there. Mm-hmm. That company, I know you were here yesterday, cutting the dividend, announcing a new CEO for Victoria's Secret, has not been able to find any turnaround, unlike a Target, which is still growing comps 5%.
But down 11% in the stock market.
Exactly.
Do I get a thank you for anything? Generally.
Thank you for being you.
Oh, thank you. And thank you for being back and being here. We miss you.
Thank you for matching your tie to my dress.
That was coincidence. Let's have a look at the markets with 20 minutes left of trade. It's not looking good. It's matching up tie and my tie and Sarah's dress. I'm not wearing a dress underneath. We're down 509 points on the Dow. We are down just over 2% in percentage term. If we check in on the Nasdaq and the S&P as well, you can see about 1.5% for both of those, and the Russell as well. Now, the Dow Transports has been hit hard. Also, Phil LeBeau has more on what's moving that particular index. Hi, Phil.
Well, they're moving down with the rest of the market. Certainly not hit as hard as what we see with retail or some of the tech stocks. But you also have to keep in mind, it's not all transports that are getting whacked at the same time to the same degree. Let's start first off with the airlines. Remember, airline stocks typically move higher between the end of September and the end of the year as they head into the busy season. Today, they're a little bit under pressure, but if you look at these stocks over the last month, they generally have held up pretty well. And here's the reason why. Jet fuel continues to be lower, and as it drops in price, that certainly helps the bottom line for the airlines, and that's the reason why the airlines, for the most part, have been able to withstand a lot of the sell-off that we've seen over the last week. That's not the case with the railroad stocks. When you take a look at those stocks, they're feeling a greater hit. Now, it's not that they don't benefit from lower fuel prices, but they don't have that seasonal uptrend that you get with the airlines. So again, you're looking at the railroads here down anywhere from 2.2% up to 4.3%, like the rest of the market, feeling pressure today. Guys, back to you.
Okay, great stuff, Phil. Thank you very much for that. Now, shares of Boeing trading lower today by significant amounts, some $2 lower in percentage terms. It's coming up for you. There it is, 0.7%. It's off the lows. It did open much lower and has helped the rally during the day. The company cancelled a conference call to discuss the issues with its 737 MAX model. The stock is now in danger of closing lower for a 9th straight session. Its longest losing streak since 2014, if it does that. Joining us now to discuss if Boeing is still worth betting on are Scott Rothbard from Lakeview Asset Management and Stillman School of Business at Seton Hall University, along with Ken Herbert from Canaccord Genuity. Very good afternoon to you both. Scott, if I start with you, you think this could be a turning point for the stock? This long losing streak might be about to turn.
I believe so. I do a lot of travel around this country. And let me tell you something. Around the world, we need more airports because we need more gates, which means we need more airplanes. When you look at the backlog that Boeing has, it's tremendous. It's going out at least 5 years plus, depending upon the model. And we're coming up to the 2019 Paris show. I think you can expect a lot of orders, and I expect orders are going to top the 2017 Paris show. So I'm bullish on the stock. I believe it can get to $400 in the next year.
Ken, why do you disagree?
Well, I would agree that the near-term correction is a little overdone on some of the issues since the Lion Air tragedy, but I'm taking a more cautious view when I look at emerging market growth, and clearly there seems to be a little risk there. Obviously, the trade and tariff dispute seems to have been much more of a head fake like we all expected a few months ago. And I think we risk, I mean, the backlog is there, but I think we risk oversupply. The risk of oversupply is significantly growing, especially as you talk about lower fuel, which, of course, takes some of the premium away from the newer aircraft.
What about the trade disputes, Ken? Do you think that that's weighing on Boeing and is something that Airbus can capitalize on? I mean, a lot of people talk about the amount China is buying of both companies' planes. Is it easy to substitute between the two for China?
No, it's not easy in the near term, right? Because it's not as if Airbus has available slots, certainly on the narrow body side. And keep in mind, 1 out of every 3 737s today, which is where Boeing generates about 40 to 45% of its cash, are going into China. So it's not easy to swap. Certainly there's things China could do with looking at the A330neo and some other programs longer term if they really wanted to tilt the balance towards Airbus. But no, it's difficult for them to do much in terms of swapping near term.
John, how much is the trade war with China a weight on this stock? I mean, if we don't get any sort of resolution anytime soon, can you be a buyer of Boeing?
Well, I think there are a lot of headwinds right now, which you don't like with airlines, certainly. But there are headwinds right now. The U.S. dollar is strong. We have the tariff issues with China. We have trade issues around the world. And there are several other headwinds. And I think those are going to begin to dissipate, and I think they're going to turn into tailwinds. I think that oil prices are going to go higher. I think that we're going to solve the trade issues with China. And I think that the Fed is finally going to say, you know what, maybe we've gone too far. While around the world, maybe we're going to see interest rates rise a little bit. And that'll weaken the U.S. dollar, which is going to help a lot with trade and companies who are going to purchase or lease Boeings.
Why are you so confident that we're going to solve the trade fight with China? By all accounts, it looks pretty complicated, and the two sides appear pretty far apart.
It looks complicated. They appear very far apart, but I think behind the scenes, both the U.S. and China know they have to have something done, and I think they will get something done. It's a matter of who is willing to give a little bit more, and I think do it in such a way that neither President Trump or the Chinese don't lose face. They both want to come out of this looking like winners. Does it happen by the G20? I'm not sure. Does it happen by the end of the year? Most likely. And I think that the more we don't hear about what's going on in terms of those negotiations, probably more advanced that they are into those negotiations. And I'm confident that we're going to see something resolved within the next few weeks or months.
And that's part of why you like Boeing. Guys, thank you. Scott Rothford and Ken Herbert with a debate on Boeing. Let's get a check now on how the social stocks are faring during this sell-off. Julia Borston has been watching that sector for us, as always, in Los Angeles. Julia.
Sarah, social media stocks continue to be volatile today. And the social media ETF following more losses yesterday, especially from Facebook. It's on track for its worst year since that ETF's inception in 2012. Now, Facebook has been bouncing in and out of the red all day. Right now, it's up, you see it up about 0.6%. And this is following a decline of 5.7% yesterday on more negative headlines about mismanagement at the company and speculation about whether or not advertisers will start to leave Facebook. Now, today, Twitter continues its decline, dropping nearly 3%. You see they're continuing this decline after losing about 5% yesterday. But Snap is a rare stock in the green today. It's up 0.3% after yesterday dropping 6.8%. So recovering some of those declines from yesterday, a little mini recovery from Snap. There's been some speculation about new spectacles, but I would say that what's keeping that stock in the green today is probably just some buying off that dip. Back over to you guys.
Julia, thank you very much. Certainly weighing on the tech sector, which is not doing as badly, of course, as it was yesterday, but certainly still suffering. Just want to also bring in Apple as well, because right near the bottom of the Dow, down as much as 5% at one point. As we approach the close, we've got the price coming up for you. It is down a significant amount. Goldman Sachs, still over 5%, came out with a second downgrade in a short space of time, downgrading their price target to 182. It's currently trading just below that. So this is what's really moved it below that level today. This is reaction to the Wall Street Journal kind of downgrades in terms of demand. But the thing I really find interesting about this note today is on their valuation. They're saying it's trading 13.9 times their 2019 PE EPS. It's right in the middle of its 3-year range in terms of valuation. But it has traded as low as 10 times PE in the last 3 years. When you throw that into the bargain, given this moving sentiment, the fact that we've only just moved back to the middle of the range,
right.
That's another factor.
Apple had a tremendous run-up this year.
Well, of course it had a tremendous run-up, but it's had a tremendous run for a decade, and you'd think with the recent pullback it would be below the middle of its 3-year PE trend, but it's not. It's right in the middle of it.
Now only at 4% so far this year. Yeah, there are some big concerns out there right now, and they've shifted into the broader market, global growth concerns, but the idea that if Apple's not going to tell us how many units of iPhones it's sold, I mean, we talk about it every day, but it does appear to be plaguing the stock, then that must be a bad sign for demand or for actual growth of iPhones. Certainly with the biggest stock in the world falling another few percent every day, it's a drag.
Worst performer on the Dow, followed by Goldman Sachs and Microsoft, but the worst performing sector on the S&P is energy, because oil, of course, is plunging. Let's get to Jackie DeAngelis for more on what's driving that drop. Jackie.
Good afternoon, guys. Well, after crude's massive downside run, there was a pause. It was a breather. The market was looking for a catalyst to take it lower. It wasn't necessarily sure that it would see it before the Thanksgiving holiday. Well, this stock slide certainly did the trick. $55 a barrel was the support level for WTI. And once the market dropped about 500 points early on in the session, that triggered the oil selling. Now, remember, The relationship between oil and stocks is always about demand. Right now, we know we've got a lot of supply. We've got the U.S. pumping close to 12 million barrels a day. OPEC pumping almost 33 million. If demand weakens in this environment, we start to see a real problem again because the stockpiles start to build up. Today's session low was 52 and change. The session high was 57 and change, a $5 difference there. Quite a range for crude oil, and it gives you a sense of how volatile the trade is. Could 50 be the next stop? Some people are saying we'll go lower before we go higher, guys.
Boy, wow, big drop in oil today. Jackie, thank you very much for the color and commentary on that one. So how much lower can oil prices go from here? Let's bring in Paul Sankey from Mizuho, has long covered oil and some of the energy stocks. Today's drop is big.
It is big, and what we're seeing here is the erosion or complete collapse of the risk premium. So when we were
is it OPEC? Is it global growth? What's the big driver?
It's the fact that a month ago we thought that we were going to get major Iranian sanctions and lose 1 million barrels a day, and the outlook for demand was that much better. The relationship between demand growth and spare capacity was very, very tight. If we lost Iran, it was even more extreme. And in the past month, what we've seen is no sanctions effectively on Iran, or no additional sanctions from an oil point of view. And of course, the whole Khashoggi story, which today I think was a part of the story insofar as Donald Trump came out and backed the Crown Prince, which tends to take some of the Saudi risk out of the equation as well.
But I'm interested that takes the Saudi risk out of the equation. I mean, surely possibility of regime change, which is offset by the president's comments, would be bad for oil. You're saying that the latest developments are, look, regardless of how damning some of these reports people are seeing are, that President Trump doesn't want to change it, but a lot of Europeans do.
Yeah, well, I think basically 20-25 bucks was Iran risk, right? So that's the big element. The second element, which is sort of an ongoing thing, is the Saudi thing. And you know, it's just notable that today oil's decline accelerated with Trump's pro MBS, or at least neutral MBS comments.
Isn't the idea that Trump's pro MBS comments could lead OPEC not to cut production because President Trump doesn't want them to cut production, and he's been very vocal about that?
I think it's more the regime change risk. I mean, if we get regime change in Saudi, it's going to be very disruptive potentially. I'm surprised the market doesn't think Saudi will cut. I think they've stated that they will, but I think it is contingent on other members and Russia cutting. So there is still risk there. Having said that, the Russians have pretty much said they're on board, or at least they're being supportive towards supporting OPEC.
All right,
so
guys, 6 minutes before the bell, guys. 6 minutes before the bell.
Today, for sure.
Well, one of the things that I guess a lot of people say, despite the oil price weakness of the big oil majors, is they've got strong balance sheets, so they can kind of weather the current storm. On that point, Exxon, with a relatively strong balance sheet, you've done some work to look at whether they could swoop in for GE, which is, I guess, in a different situation.
No, I think it was just a conceptual idea that, 15 years ago I was covering Exxon, was the biggest stock in the market, and was duking it out with GE. And obviously, you know the story of what's happened to GE. Exxon's not been great, but GE's been truly a disaster. And it didn't
6 minutes before the bell, guys. 6 minutes. Get your plays in, lock your profits. Do what's necessary.
Chain would actually fit with Exxon if they wanted to do a big deal. I think it's a very left of field idea. That's my right hand. A very left of field idea.
Right, to the viewer that worked.
Yeah. But we just threw it out there this morning as something that, I think there's a couple of positives for oil. Firstly, the spot price has come down a ton, but the back of the curve has not moved a lot at all. So we've seen a move like this, and we're actually at a very flat curve. Secondly, the equity price performance means we can get activism and we can get M&A. And so really we're throwing out ideas there for who can merge with who can buy who. Can we get some activity on the M&A front in oil, which is really, frankly, what we need. We need these companies to lower their costs and raise their returns.
What's the highest conviction M&A deal that you're throwing out there?
Well, I think Exxon to buy something in the Permian is something that's pretty well established across the news wires. I can't start rumors, so I'll be very careful what I say right here. Further mergers within the Permian would make a lot of sense. You still haven't optimized that. We saw another deal yesterday. I think they'll continue. Those are the big ideas, and certainly the absolute disaster in Canada that's going on right now would surely lead to some more consolidation there.
Some huge dividends on offer, including in the European majors. All of them sustainable?
Yeah, they are. I mean, for example, if you look at the bellwether Exxon, that's a very sustainable yield. So you can buy, if you're attracted to 4% for Exxon or 7% for Shell, those are very safe with the balance sheets that you mentioned.
Paul, thanks so much for joining us, Paul Sankey, outlining some opportunities despite a big fall in WTI.
Not a single stock in the S&P energy sector is higher right now. We've got a news alert on Walgreens. Bertha Coombs with the details. Bertha.
Right here, Dow Jones reporting that Walgreens and Humana are in talks to potentially take stakes in one another, but certainly that those talks, they say, are wide-ranging and would likely include talking about extending their partnerships. Walgreens and Humana launching a couple of new clinics in the Kansas area this fall to treat seniors. They want to use them more as primary care clinics. Now, Humana has said that this new partnership with Walgreens does not mean that it won't continue its partnership with Walmart, where it has already established a partnership, signing people up for Medicare Part D plans and getting seniors to go to the clinics in Walmarts as well. It's part of Humana's broad effort to really provide more services to keep seniors out of the hospital, treat them at home, and find new ways to keep them healthy and keep them engaged in their health. Well, Walgreens still low on the day, but well, you can see a lot of these insurers and clinics want to partner up as CVS and Aetna are poised to complete their merger and really bring that model.
3 minutes for the bell, guys. 3 minutes.
Bertha, thank you very much for that. We have about 3 minutes left to trade. The Dow is down 530 points. The low is down over 600 points. Kenny Polcari joining me here on the floor. I'm not sure why we're coming to you, Kenny. Yesterday you said we were going to open higher.
I so didn't.
You called it. You called it. We opened low. Why did you call that yesterday? What about tomorrow?
Because, you know, we closed it to the lows, not right on the lows, but close those, and it felt heavy. This morning, look what happened, right? Boom, right out of the gate, and it hasn't really been able to recover. Now, look, we traded right down to where I thought 26.20 is where I thought. We traded down to 26.34-ish. So I still think, my sense is it still feels heavy, that it really wants to test that level. It may not test it today, but I wouldn't be surprised again as we close on near the lows again today that there's another flush tomorrow, right? There needs to be that flush in order to get people awake.
We talked about that flush yesterday. So, I mean, it feels to me these last 2 days of declines are pretty serious. Added to last week, you haven't had enough volume.
They're serious. We haven't enough volume, but you haven't seen the level of angst really, really build, right? You need to see the level. I hate to say it, but you need to see the level of angst build. It's almost like you don't want to say panic, but it's got to be a real push, and they got to test it. They got to make sure the buyers are going to be there, and I think they will be there.
Difference between yesterday and today: the Nasdaq's not the laggard of the big indices. Is that something positive to hang on to?
Yeah, you know, you might be able to say, but the Nasdaq's getting so beaten up that, you know, it gets a little bit of a break. It's okay, but overall, it still feels heavy, right? But look, valuations had gotten so elevated based on near zero interest rates. Yeah. Now we're trying to normalize. You can't expect the market's going to keep going up.
Last thing, tomorrow another down day.
My guess is tomorrow, I think we're going to open low tomorrow, but that ain't going to rally.
Kenny, thanks very much. I'll leave it there with you. Let's have a look at what the Dow's doing as we approach the close. It is down 534 points. The low is over 600. Here are all 30 stocks for you. Every single one of them red and meaningfully red. Apple's down some 5%. Goldman Sachs down sharply. Microsoft, Disney, they all prop up the bottom of the index. So the tech names like Apple and Microsoft are in that group. But if we look at the S&P sectors, you'll see it is energy that suffers most of all. Of course, we just discussed that with
all right, that's it, guys. Do or die.
The other sectors that are suffering.
Day is over.
We've got tech suffering, banks suffering, energy suffering. It's really an ugly picture. Even utilities down, every single sector down. That is down 0.4%.
That is it, guys.
10-year yield as well, because we mentioned that earlier with Rick Santelli, remarkably stable in light of this. It's been around that.
A day. What a day.
Or so. For most of this week, and it is there at the moment. Seema.
Sell-off started overseas with tech shares underperforming in Asia and Europe. And then that retail story, that really resurrected these concerns around the state of the consumer. Will that continue is a big question. We have Foot Locker and Gap after the bell. And then Deere, a major industrial player that has been underperforming all year. It's down about 12%. I have this report.
I think it's major lag in it.
Thank you very much for that.
A major lag.
The Dow is down 2.2%. S&P and Nasdaq down around 1 3/4% each. That goes to Bell Baycrest at the 90 GRI.
All right, so we have Foot Locker, Bison,
on the
Foot Locker.
That does it for the first hour of closing bell. Sarah, back to you.
So let's see, Billy has it tomorrow. Autodesk, excuse me.
Another big sell-off on Wall Street today. Welcome everyone to the closing bell.
Who else?
Kelly Evans. Wilford Cross in his suit will be rejoining me in just a moment,
right.
along with Mike Santoli, as always, CNBC senior markets commentator. And let's take a look at how we finished up the day on Wall Street. Big losses again across the board. The Dow closing lower more than 2.2%, down 553 points there on the close. The S&P 500 down 1.8%. All sectors did close lower.
Just get my little stuff together, guys. Forgive me. I get my little earning plays in. Get my earning plays in. Forgive me. Clean up some of my positions. I also get my earning plays in. So Billy, Autodesk, BJ's, and Gap Store.
Basically, all the gains for the markets and the major averages have been lost for 2018. The Nasdaq is now flat for the year. The S&P 500 is down more than 1%.
Autodesk, Foot Locker, Billy, yes, a Billy as well. So yeah, they're gonna be some big names with those. We'll watch those. We'll watch those. Billy, Autodesk, Autodesk. I keep on saying Autodesk.
2% decline for the Dow Jones Industrial.
And
What's
we'll
interesting
watch,
about today is that it was a broad-based decline with sharp drop in oil prices, accentuating the sell-off in energy, the energy sector. That was the key laggard across the S&P 500, followed by financials, technology, consumer discretionary on those retail concerns. Those latest earnings reports, Target, Lowe's, Ross Stores, casting concerns over the state of the consumer ahead of the critical holiday shopping period. And we're still in the middle of the retail earnings season. For the month, real estate and utilities still faring the best so far, although they did end lower in today's trade. Earnings tonight, still the big factor in focus here on the floor. Watch Europe very closely tomorrow as well. EU officials are expected to respond to Italy's draft budget. The timing of the sell-off, guys, here in the United States, S&P 500 has had 6 straight years of Thanksgiving week gains, but this sell-off that we're seeing not just today, yesterday, could certainly break that streak. Guys, back to you.
Seema, thank you very much for that. Let's head uptown to Bertha Coons at the Nasdaq for summary of what took place there today. Bertha.
You know what? We had some relative strength for the day in chip stocks, and the chip sector was even positive for much of the morning, but that faded, and it really could not really contradict what we were seeing in terms of the point impact from the big cap tech names that were all lower today. Apple now having lost about $250 billion plus of its market cap after having been a trillion-dollar company. Microsoft, Cisco, and Amazon today caused the biggest point drop, taking the Nasdaq down below the October low. The Nasdaq 100 still up for the year, the best performer among the major indexes. Now we're going to watch to see whether it can close above the
tomorrow. I
year's
think it's going to sell off tomorrow some more, so
which is
need to cover that.
66.30. One of the interesting things that technicians are watching, some of the Nasdaq technicians here at the Nasdaq market site, the number of new lows. We saw new lows today and strong volume for NVIDIA.
4:35 is Foot Locker, 7 p.m. is Billy, 4 p.m. is Autodesk. They late. Gap reports at 4:15. BJ's is after market close, no time.
When it was 25%.
Again, Billy at 7 and 7 p.m. because China stock obviously, and Foot Locker is at 4:35. And we also have some other stocks as well, so like China stocks and Starbucks and Shippers, VNet, Quada, LTM. That's going to be a big mover. Potentially, it's supposed to be a big mover. LTM. A lot of implied volatility options move baked into that one. That it may run. Yeah, so real quick, I'll share this real quick here. This is the earning plays for this evening. After hours here, some of the stocks that they'll be running. So we have, again, Foot Locker here. Supposed to report at 4:35, give or take. Sometimes they be early, sometimes they be on time, sometimes they be later. Billy, again, Chinese stock. You can go look up Billy. Again, it's just some of the stocks that are predictive. You know, they're predictive moves. Not necessarily means it's going to beat or they're not. Foot Locker expected 36%, only 30% win rate, potential beat out of 100. That's not good. Not necessarily means it's true or don't. These are just, you know, analyst prediction values. Autodesk 58%, BJ's 47%, Gaps, like nobody giving Gaps a chance. 25% beat. And that's because everybody's scared because the retail sector is getting pummeled. Right? So you got Copart, I think that's like a part company, I could be wrong. Caleris, Keysight Technologies, Latham Airlines. Again, this company is supposed to have a 20% potential implied volatility move. So it may, we'll see if it moves that much. It may or may not, but it's expecting a big move.
Well, one
one party
Quada, again, VNet.
There's a new game, which is let's find the bottom.
Starboat Carriers, again, shipper company. Look at that. They're spending 100% expected revenue growth. So whatever they're doing over there, it must be good. But apparently, everybody's not excited about them beating them. So that might be because they've just been selling off a lot. The same with CE, 43% potential move. China Finance Company, XRF. Let me see what they got. 22% beat potential favorability. Esteline Technologies, what they're saying, 33%. You got Barnes and Nobles. Even Barnes and Noble got earnings. I forgot. And PDD had. Yeah.
A year ago.
Yeah. So these are some of the stocks that have earnings after hours, guys. We'll see what happens. Excuse me. What happens? It's going to be crazy. It's going to be crazy.
If in fact
right? We shall see, as they say, right?
We can feel more comfortable
we shall see.
Buying stocks, particularly if there's a trade deal.
All right. So let me go over
so
here.
Ben, what's your level of pessimism around some of these big market drops?
Yeah, I think this is, as Mike said, a retest to the low. It's eerily reminiscent to what happened.
Man, it's going to be crazy after hours. It's going to be crazy. So Foot Locker, okay, Autodesk already dropped their numbers. It's off and running. It's off and running.
Situation is still reasonably good. We're just not seeing a recession in the near term. I think there's a big difference between the slowdown.
So it's up there at 134.
Rates of earnings, revenues, GDP.
Foot Locker is up and running right now. They must have dropped their earnings numbers already. Let's see what Foot Locker dropped. They must have beat, obviously.
Could we be about to see credit spreads?
Yep. They dropped their numbers. So 3Q net was 130 million. Third quarter sales 1.86 billion.
That really drove high yield spread.
Earnings per share $1.14. Earnings per share beat 95 cents over 92 estimate. Sales was 1.86 billion over 1.85. So they came in kind of they beat on top and bottom basically. Now you got to wait and see what the guidance is going to be. Right? If their guidance is going to be good or whatnot. Right now, Foot Locker is squeezing up here after hours, gapping up here above the $50 handle. So it squeezed up so far about $4 and change. We'll see will it hold or is it going to turn around and sell out like we saw the other day with who's that? What was the stock? L Brands, excuse me, L Brands. All right, so we'll see how that turns out. So as of now, that stock is gapping up. As of now, that stock is gapping up. All right, so interesting to see how that stock performs here after putting up those numbers. Right, so Foot Locker already beat on earnings. Right. Autodesk definitely dropped their numbers, and so far they're up, squeezing out the hours here. So they definitely lost 11 cents versus 55 cent loss year last year. So again, they slimmed their margin, the loss error. Their revenue was definitely their revenue was like gangster. Oh man, 660 million over the 500 and what was it, 513 million Q3 revenue basically. So they blew their revenue out of the water. Right. Way to go, Autodesk. So another one turned it up here after hours. All right. And then BJ's is the next one. BJ's wholesale club. Y'all pretty much know about BJ, excuse me. They dropped their numbers apparently, and the stock is now up very modest. Actually, they ain't really gapped up a lot. I guess people are still processing their numbers.
That's what the short end has been telling. It's down from 295, and that's only the market's best guess.
Not necessarily great because
foretelling what the Fed's going to do. It's really not all that accurate beyond a couple of months or 3
the stock definitely is not moving.
So, the story can change.
So they raised their guidance. That's good. The earnings per share was $1.17 out of $1.24 as opposed to $1.22, $1.26 estimate.
Carrie, how much of your investment thesis right now has
So
to do
okay,
with
so they raised their guidance. That's always good. That's always helpful.
Well, I would
would say it
doesn't necessarily mean it will be
huge impact because
enough to sustain the asset, but we'll see here. Right now, it's gapping up on no volume, though. No volume at all after hours. But it is up. Nonetheless, it is up. So again, Foot Locker is squeezing, going higher here. Billy is.
I understand that has their expectations about inflation.
Billy is just kind of wait. They got earnings at 7, so it don't worry. It don't even matter with that one.
And you have pressures.
It don't even matter about that one.
It's unlikely that there will be more rate
right now
at all, as have been suggested. So
the volume is starting to come in now, actually a little bit now into BJ's. It's starting to move a little bit here.
Than really about interest rates.
GPS.
I'm quite comfortable where we are right now.
Everybody kind of waiting on that one.
Not where
they does that again, 4:15.
That we would be at the beginning of.
So retail again, that's gonna be interesting. Gap. I mean, Gap. People still shop at Gap store though. People still shop at Gap. You know, again, I don't. You know, give or take. I know hit or miss. Yeah.
When you look at dollar,
yeah.
Dollars doing a lot
but you know, we'll see.
Fed's worried about inflation. 8% increase.
We shall see.
The dollar is helping. Energy prices going down, helping. The real challenge is the Fed is tightening into a non-inflationary environment.
That one there is going to be a high flyer.
They're off zero now, and I do think
possibly.
The markets are looking for a pause, and the markets might.
When they drop their numbers.
After December.
After December, yeah, December is pretty much in, but the.
I think that was a kind of low float too.
March, if everybody's looking for the next one to be March, that's what we'd be looking for. Then I think the answer to your original question.
Interesting day again thus far.
Because then that increases the risk.
Foot Locker up there at 51 now, going higher. Foot Locker going higher.
Kind of stabilized, and
Foot Locker squeezing up to the upside on Jokers, tearing it up.
Over the last 4 to 6 weeks, but we were really worried about a flattening inversion.
Tearing it up to the upside.
That even more if the Fed doesn't pause in 2019.
I still think a lot can change. I mean, one thing the market's been uncomfortable with is the fact that after December, the Fed's talking 2 or 3 next year. Well, that could be spread across the year. That could be all in the back half of the year. The Fed seems to think it has enough flexibility in the standing forecast. The market doesn't like that. The market doesn't like the suspense involved in that. And if we want to go back again to the 2015, 2016 experience, you know, that was when Yellen was trying to get the first rate hike in of the cycle. The 2015 got it in,
space sector.
and no more for a year.
Possibly better off. We'll see.
Complicates all of this because if they pause, it's going to look like he's listening to the president.
I thought I was still sharing.
Not what he intended when he
one
made
second,
the comments, but he might have shot himself in the foot. Meantime, we have an earnings alert. It's on Foot Locker.
Foot Liquor. You might call it Foot Liquor. We got to earn it on Foot Liquor.
For the third quarter results, they're turning in earnings of 95 cents adjusted compared to estimates of 90 cents.
Foot Liquor. Foot Liquor.
There. Also beating on stronger than expected revenues, 1.86 billion.
Foot Locker.
Have been looking for 1.
Foot Locker just drugged them short. They thought Foot Locker was going to sell off. It was a lot of people buying puts too. Ooh, they get squeezed right now.
You can see here more than 11%. And a quote from the CEO in the press release, Richard Johnson, says, quote, "We believe we are well positioned to produce even stronger results in the all-important holiday selling season."
So they're going to raise their guidance.
Overall,
good for Foot Locker.
Is not really, we're not sure exactly what he's relating to, but perhaps even stronger than this strong third quarter is what he's referring to. Back over to you.
All right, a pocket of strength there and an ugly day for retail. Courtney Reagan, thank you. Foot Locker soaring 11% after hours. Nike's gaining after hours as well. It's a big supplier.
Good tell, right? I mean, and obviously, I think you naturally would have had people after this morning's run of reports from retailers and last night leaning in the direction of, I guess, bracing for something worse. So the comps number and obviously the comments about the guidance, maybe tell you that that athletic footwear is an area that's not seeing any.
Carrie, of the retail names that were tanking earlier today and the sector broadly, would you want to buy any of those?
The only retailer we own is Costco. I think this is very positive for the retail sector generally. If Foot Locker, which has the exact same pressures that every other retailer has, which are
sales were
and unit costs,
yeah,
and
177.
Say that they're
net
going
sales.
to show stronger earnings than investors might have thought previously. It's not just about the athletic shoe business. It says something positive about retail, and that's what the economy, that's what the market is worried about. Whether margins will be under pressure, whether those costs that are definitely coming through on the labor side are going to overwhelm the better numbers on the revenue side. So I take that as a plus. I think that will be helpful to the sector tomorrow.
And on top of that, athletic sneaker sales are actually doing well.
Yeah.
They're in an innovation
Let's
uptrend
get,
with Nike, Under Armour, and Adidas right now. Housing stocks, we should mention, actually bucked the downtrend, closed higher today, including Toll Brothers, Lennar, KB Home. Housing starts rose 1.5% in October. That
Foot
was
Locker
a weaker
squeezing
number.
higher.
Interesting
Gap.
to see it did in the stocks, though.
Yeah, this
Gap
is one of the
stores
examples
is
when you look at the overall action today, the really beat
Narrows
down
got
basket
it.
areas of the market did. In
255
that includes
as of
semiconductors,
255
and
260.
and Facebook, right? Exactly.
So the
which is
estimate
well
was
stretched to the downside.
256.
So it does show you, you know.
So it looked like their guidance is pretty much in line.
Their sentiment number earlier this week, yesterday.
They didn't change that.
That seemed like a capitulation moment.
Guidance from 255 to 270 August of 2013 to
it definitely
okay,
helps,
still 2000, August 23rd.
It changes
Wow.
the sentiment for these stocks.
Now, President Trump has just made some new comments on the Fed. Eamon
69 cent expectation was 67 cents, so they beat by 2 pennies there.
The president was getting on board Marine One in order to depart to Florida for the Thanksgiving holiday, but he stopped to talk to reporters.
Third quarter.
Let me bring you a couple of segments of what he had to say. First, on the Fed, the president was asked about today's market sell-off.
About 800,000
the tech stocks are
in revenue. They had an estimate for.
He thinks those will come back, and he went on to talk about the Fed and what he sees as a key problem.
Yeah, like I said, Gap, people still shop at Gap. They may not be
I'd like to see the Fed with a lower interest rate. I think the rate's too high.
Type of store that people just
a Fed problem than we have a
beat down, but Gap still has some lower customers, loyal.
The president also talking about
customers,
Saudi
that is.
Arabia here, and that statement that he made earlier today about the murder of Jamal Khashoggi, the president refusing to break with Saudi Arabia despite the CIA's reported
They selling into it though. Like they trying to sell into it.
Salman, the crown prince of Saudi
Foot Locker
Arabia,
tearing it up right now. So
who ordered that murder?
I'm tripping because I was like, man,
y'all
tripping, my short Foot Locker.
We may never know. Today,
still got some of that Nike money baked in there.
He added to that and laid out the economic case for not breaking with Saudi Arabia.
You short it up here at this top here, then
we're not going to give up hundreds of billions of dollars in orders and let Russia, China, and everybody else have them. It's all about, for me, very simple. It's America first. Saudi Arabia,
67 narrows, Gap narrow,
I think
Gap
your
narrow.
Prices would go through the roof.
Got it.
Kept them down.
Again, so they're saying
helped me keep them down.
4.1 billion versus the 4 billion.
Relatively, I'd like to see it
net
go down even
beat.
lower.
So they beat
lower,
there.
But I think that.
So I think the guidance is what has everybody a little pause.
Make America
great
right
again,
and I'm about America first.
So Wilford, the president explaining there the prism that he's dealing with this problem through, and that's economic. It's about orders, it's about oil prices, and the president says ultimately he doesn't want to change the
69 versus 68, so 1 penny.
I know it's the Fed, the Fed, Eamon, and the president hasn't changed his tune on that, and clearly investors agree with him. We hear that all day long here as well. But people also blame the trade war. Is there any sense that he could at least moderate his tone or approach with President Xi when they meet at G20 because of what's happening with the markets?
Well,
so the guidance is lower.
I mean, I asked Larry Kudlow that question here on the White House driveway.
So yeah, they did lower their guidance.
If the president sees any responsibility in terms of the market slide that we've seen from his own trade policies, and Kudlow just didn't want to go there. I mean, he said today that he doesn't think there's a recession.
Again, they beat on top and bottom.
He doesn't believe the analysis that the
but they beat.
Production is going to slow down next year, going into the
nonetheless they beat.
And, he remained bullish on jobs and the economic performance generally. So this White House is not one that is ready right now to admit that it has a problem in terms of the economy. They are
-7 versus 1% last year.
I think a lot of folks here believe if they can get
that, they lost money there. But Navy Global same store was positive 4% versus 4% last year, so they didn't really grow in the Old Navy department.
On the Khashoggi murder and
the same value where it was last year, but yeah, they beat on top of bottom.
To the G20, if the Saudis can break the rules and get away with it, why can't we, the Chinese, do that?
Sure. I mean, that's one of the questions here. Is the president basically issuing carte blanche to any country that wants to murder journalists,
be flat to
so long as
slightly.
it has a lot of economic ties to the United States? And that's going to be the criticism in the immediate
yeah, we have to wait to the conference call
here. And one of the things I'll be watching for in Argentina is
now they can't figure out what how they want to do trade this stuff.
It's all over the place. Going to Argentina, and the president may in fact encounter him. And so, what conditions will the United States put on a meeting with MBS, if any, or will the president happily shake his hand in front of the cameras in Argentina? That's going to be a fascinating moment. And along with that, Xi Jinping face to face, and so many more elements of diplomacy at stake in Argentina.
Yeah, they got in a little lower, but
Eamon, thank you very much. Eamon Jarvis for us in DC.
Gap earnings are out. Courtney Reagan has those numbers. Courtney.
Hi, Sarah. So Gap for the third quarter, it did beat estimates for profit here, reporting 69 cents. The street had been looking for 68 cents. Revenue is also stronger than expected at 4.09 billion. The street had been looking for 4 billion even. Gap did, however, lower the high end of its earnings forecast for the full year. So now it's 255 to 260, and the street's estimate is sitting at 256. If you look at the comp sales, they were unchanged, flat. The street had been expecting those to rise about 1%. And within the numbers, Old Navy still strong, up 4%, but that Gap brand, that key Gap Global, down 7% on the comps. And Art Peck, the CEO, says we are clearly not satisfied with the performance of the Gap brand. We know this iconic brand is important to customers, and we are committed to taking the bold and necessary steps to ensure that it delivers value to shareholders. Shares of Gap were lower. Now they're higher by 2.5%. Will?
Well, thanks very much.
Now they're a little lower.
Retail reprieve?
A little bit, yeah. I mean, Gap is obviously, in big picture-wise, a very cheap stock, a cash cow with high dividend yield and buying back a ton of stock, a lot of free cash flow, but really no growth. I mean, growing it slower than
except for at Old Navy. Old
Navy, but there's always one division that's fouling up the quarter, right? And I do think the stock has been really discounted enough right now that it's not going to be a surprise if the numbers aren't wonderful across the board.
Old Navy has good baby pajamas.
That's true.
Well, I thought Bed Bath & Beyond was the brand.
No, that's Bye Bye Baby.
That's Bye Bye Bed. Okay, there we go.
They grow fast, so it's good to get cheap pajamas.
Gotta get Samuel a Christmas present. Anyway, we will leave it there. Ben Pace, thank you very much. Carrie Firestone, thank you very much. Now, stocks plunging, of course, today, and our next guest says there are 5 unresolved risks to the market that investors still need to worry about. That list is straight ahead.
Plus, is the Fed really starting to rethink its rate hike plans for next year? We're going to ask the CEO of asset manager Cowen later on the Closing Bell.
Fiscal 18 tax rate about 25%, comparable to that of 26. Compared with previous guys at 26, so they lowered that. Spending approximately again, yep. Yeah, so it just stuck here, man. So and right now it's killing options. Anybody got options out there? It's murdering them. It is murdering those option plays right now. Good idea for anybody to short a Foot Lock up there in there 52 right now. They're about near $1 a point now. So interesting with that one. So the conference call is gonna be everything for Gap. It's gonna be just like how L Brands was yesterday. I just got this feeling. It's gonna be like, is this gonna break out or is it gonna break down? And right now, it's stuck in purgatory. You don't know how to trade it, or people don't know how to trade it per se. It's just flat. It just went right back to what the closing price was, and now it's just sitting there. Again, they beat by 1 cent, and they beat again by $89,000 or 80, yeah, somewhere around there. $89,000 on earnings. Oh, excuse me, 89 million. I'm talking about 89 million. Give me. They didn't grow, basically. That's what the number's saying, that they just didn't grow that last quarter. They kind of stayed flat. But with a lower guidance and you had a flat growth value, that ain't good, because that means you're not positioned to have free cash flow. I mean, they got some on the books apparently, but if you're doing any kind of major M&A or marketing, it's going to eat into that, because you didn't have a extra boost of income to pad the books, but again, we'll see.
We've got an earnings alert and a move on Autodesk. Eric Chemi with the details. Eric.
Autodesk reporting earnings that were better than the street was expecting, both on the top and the bottom line. Also, the guidance going forward on the higher end, better than analysts were expecting. You can see the stock, they're up about 9%. It was up 10% earlier. The company also buying a company known as PlanGrid. It's a construction productivity software firm. That's also part of the earnings announcement here today. So there you go. Autodesk up 9%. Stock's been down by more than 20% since October 1st. Back to you.
Eric, thank you very much for that. Now, the Dow plunged 551 points in today's session, and our own Jim Cramer outlined some market problems that need solving. They include Apple demand slowing, Facebook management, software stock drops. The full list is there, and take a look at CNBC.com for the full write-up.
And the list appears to be growing by the day. Our next guest drew up some similar concerns. Scott Wren joins us with market worries being trade, the Fed, oil, China, and technology. So a lot of overlap there, Scott. Does that make the hurdle higher to get any sort of bounce or recovery in the market, the fact that the list grows by the day?
Well, Sarah, I tell you, I think you could actually narrow that down to three. One, is the Fed going to make a mistake? Is global growth going to slow? And are we going to see a margin squeeze? And if your answer is no to all of those, which that is our answer, you need to be stepping in here and buying some stocks. So there's a lot of underlying things going on. But, you know, I'm sorry, Wilford?
Your answer is no to all three?
Our answer is no to all three. Not that they are zero probabilities, but we believe they're low probabilities. Let's face it, we're playing a game of probabilities here. Our outlook is for good economic growth, not great, modest inflation. And if that's the outlook, and we don't think any of those key things are going to come to fruition,
so we'll listen in on
we want our clients stepping
Gaps
in here.
earnings call if nobody else, even though Foot Locker's on, probably be interesting too.
25.82.
But again, it's always good to get some good research in terms of listening to conference calls, understand how the fundamentals work for a company, you know, the different metrics that they use to kind of quantify that growth or lack thereof. So it's always good to use that as a good, you know, learning tool. You know, again, you can literally just, you know, log into a lot of these companies, investors relations website, and listen to their earnings report. You know, another way of getting some good data, some good homework, you know, in and learning the industry.
Well, Mike, I definitely think that's what's really driving this sell-off. For those
that extra loud. That was extra loud.
I mean, on let's say, for instance, technology.
So let's go find out what time.
Surprised that when you have $1,000+
let's see.
The demand goes down. There's a price point.
And it's still gapping up here after hours. After we caught that one, look at it. It gapped up above that 5. Remember, said broke resistance at 5 and get above that hold. That stock went all the way up to like $6.75.
So that's
we were watching it first. Picked up $1 and basically $1.70 a share. If you'd caught that thing right before, you know, right when we was looking at it at the break of $5. The break of $5 resistance there. So this is what I'm talking. That's why I love. This is why I love. This is why I love what we do. All that money was made right there in that moment. You know, as soon as that alert went off, we were there. You know, we was right there to, you know, again, capitalize on it had we chose to.
So, Scott, you became even more famous than you already are when
the
president
so let's see.
made a comment that you said.
Earnings call.
If the Fed backs off and starts talking a little more dovish, I think we're going to be right back at our 28.
No, I don't listen to your call.
Quoting Scott Wren of Wells
Fargo. Starting in 0 seconds.
But you're
BJ's.
saying it's not all about the Fed.
So they haven't started that yet. So most of them are going to be around about 5 o'clock. Yeah, most of those conference calls are going to be around about 5 o'clock. Upcoming calls, Foot Locker, yeah, 30 minutes. So yeah, 5. Foot Locker's at 5. QAD, we saw that at 5. Yep, Autodesk at 5. Gap at 5. All right, so yeah, we'll just wait around. You know, again, we got 30 minutes. Well, obviously myself, I'll be waiting around, but I say you guys got to. We'll listen to some of these conference calls, get some nice little insight on those. Again, Billy, since they report so late at 7 o'clock, their earnings call is not till like basically 3 hours away from now, 3 hours 30 minutes.
In our opinion, you're going to be
so roughly, you know, again, 7:30, 8 o'clock, around that 8 o'clock handle. In the U.S. market at that point, in terms of retail value like that will be closed. But again, I'll probably be listening in on it.
All right, thanks, guys. Fog up.
Let's take a look at how we finished the day on Wall Street.
Right.
Lower. The Dow was down 2.2%, 551.
So far after hours, we have the biggest gain is INPX up 13.6%. Foot Locker up, obviously 11%. HIFR, Autodesk, again, we spoke about that. Keys, they had earnings tonight as well. Again, they're up 5.8%. BJ's had earnings tonight, they're up 5.7%. WFT, Blue Apron's up 3.7%. JCPenney's back up after, again, there go JCPenney, still creeping up, holding that $1.20 plus area like a boss. I'm not mad at him. I'm not mad at him. Nike's up, obviously, off that Foot Locker beat. They're up 1.6%. LB's up a little bit here at 1.5% basically. So definitely trying to retrace a little bit off the lows actually at this point, but not a whole lot worth getting excited about. I still have a couple more puts left in the LB. All right, I sold off some. I left a couple of them in there to keep running. I think tomorrow we'll see how it reacts to some of these other, well, just one or two little retail stocks left. Obviously, Gap in another one, so we'll see if it gaps back above 29 and hold, or if it pulls back a little bit more deep into the $28 handle. The test of lows are 28. So after hours again, after our losers. Pretty much again ANY obviously because it gapped up so high. 10% is not a lot in terms of where it gapped up from. CAL, they had earnings tonight. Again, they sold off a little bit, 6.7%. They're down. NSPR, as fun. You guys is down a little bit here, as you see, 3%. HNY obviously stays all over the place. They need to start going to a little reverse split, get that out the way. Right. Yeti ACB, marijuana company ACB, that's a marijuana play. They're down 2.5%. Yeti the cooler, Fisherman's Cooler Company, they're up down 1.9%. Excuse me, they were up actually pretty decent yesterday off of Kramer Pump. Jim Kramer pumped it. PDD, again, they had earnings. I don't know if they dropped their numbers yet, but as of now, it's down 1.8%. So that might, I think they're gonna drop late because it's a China company, just like how Billy is. So as of now, it's just kind of sitting in a purgatory, down about 1.8%. OPK, EC, GNC, AMRN still selling off a little bit. I've been fighting a lot of bulls about that little raggedy stock all over Stock Twitch and Twitter. Fighting them jokers, but I've been winning though apparently because the price ain't up there above $20. It was screaming it's gonna be 20 and 30 bucks. Like, no, bro, y'all daydreaming. So y'all don't check fundamentals. Y'all just emotional, calling out numbers and it's not even validated. Pseudo bid, right? They're gonna learn today. They're gonna learn today. Right, so that's what I see after hours here so far. Again, just Foot Locker still holding its own up here. Just above the $51 handle. Again, Nike up because of that. Adobe up a little bit after retracing some of their sell side activities today. It's up 1.4% after hours.
Even in the first uptrend there.
Right, so that's about it. As of now, again, Gap ain't doing anything. Just sitting here still. As of now, it's just dead. I mean, that stock is just dead. So I guess everybody's waiting on the conference call.
It really was people hiding in these stocks as opposed
Cash
to
Shadow, Gap brand. So forecast is currency fluctuation, positivity impact. Yep.
Coming up, we will
estimated about one. Yep.
That tech can turn around and make a comeback over the short term.
That's just the business as of now. So again, everybody waiting to see what it's gonna do. Are they just gonna get excited and buy, or they gonna like, no, I'm out and sell. One way or the other, it's gonna make a move here after hours at some point. So basically, no one's really selling, no one's really actually buying. One thing is for sure, it sold off a little bit earlier though. It was brutal, a little brutal. So we'll see here how that turns out. All right, so again, as of now, the market's kind of sitting in the flux still. Nothing major. Besides, the ones that beat obviously BJ's warehouse. If you shop at BJ's, you got a reason to go in there, feel excited a little bit now. I mean, you picked up by what, near $2 a share. It came from 1980, 1985, 1990. You know, up to 2110. So again, a dollar, some change. Foot Locker obviously being a big movie here, up, you know, $5-6 almost. The Autodesk just obviously crushing for the big stock is 121, got up above 137, 136. It's a big gain on that. All right, so that's pretty much where we at here, guys. Other than that, awesome day. A lot of good lessons learned.
President Trump making some new comments about the Federal Reserve in the last hour outside the White House.
Oh, that's a little too loud.
I'd like to see the Fed with a lower interest. It's too high. I think we have much more of a Fed problem than we have a problem with anyone else.
Wow, that ain't gonna fare well.
Another job there. Steve Leeson joins us now with how this and the recent market moves could impact the Fed's timeline for policy. Steve, this makes it a little more complicated, doesn't it?
It sure does. You know, Sarah, the president in the past has said the Fed has gone crazy. These recent comments might seem benign, but they come with at least some members of the Fed questioning whether they ought to hike even in December. Trouble is, the more the president says, the more the Fed is going to appear to be knuckling under to political pressure if it doesn't hike. Here are the probabilities now. We're looking at a 75% probability of a December hike. That's down from a 90% probability a few weeks ago. Pardon me. June now is the odds-on bet for the first hike of 2019. It had been March, so that's been pushed into the future. And then we can't even get to a 50% probability right now for a second hike in October, which is 31%. Last week, Philly Fed President Patrick Harker said, quote, "At this point, I'm not convinced the December rate move is the right move, but I need to watch the data over the next few weeks." On Monday, here's what Fed President John Williams said: "We'll be likely raising interest rates somewhat, but it's really in the context of a very strong economy. We're not on a preset course. We'll adjust how we do monetary policy, do our best to keep this economy going strong with low inflation." The center of the board still seems committed to bringing the funds rate to what they call neutral. That's in a range of 2.5%, 3.5%. I think it's going to require more than the stock market itself to keep the Fed from going to 3%. The data will have to weaken. If it does, the Fed could pause in the lower range of neutral, which still means we'll have work to do, just not maybe as much as the market at first thought.
Steve, stay with us. We're going to continue discussing this. Jeff Solomon has joined us on set, the Current CEO. Very good to see you. Thanks for joining us.
Yeah, good to be here.
Jeff, what's your take on whether the Fed is going to look at the recent volatility and decide we should step back from these rate hikes?
So maybe I'm like a Fed purist, but I think they look at this and say, you know, stuff like this happens in markets, and they'll be looking much more at the economic data. I think that's a much more consistent thing for all of us to be looking at, frankly, than day-to-day volatility or month-to-month volatility. So I'm still.
Does that suggest they should take a pause?
No, I'm still in the camp that they probably have one or two more left at least. You know, and they'll look at the data.
But only one or two in the next year would be taken as dovish from the market.
Yeah, well, I don't think they're in a hurry. I think they'll be judicious and cautious with it. So I do think they have some room because they're always concerned about creating an inversion, which would be really bad, I think, for the market. So there's some room here between, you know, Fed funds and sort of the 10-year and the 30-year. There's definitely some room for them to play. And I agree with Steve, somewhere between 2.5 and 3.5 is neutral. If they got to 3, that'd be a real psychological victory for them. And there's going to be a real push for them to do that, I think, based on the economic data that we're seeing.
Yes, Steve.
I think it's the Fed may have done a disservice by not pointing out, and I'm not sure this is true, but I think some of what the Fed wants to do in terms of raising rates is kind of disconnected from the data. And I think this move to neutral and the other idea, that the other side of that same coin, is taking away the emergency rates of the financial crisis. I think they want to do that. They'll do it gradually. They don't really want to upset the market, but they still want to do it. And I think that move is sort of disconnected from the data. I think there's more they may have to do if the economy ends up still going gangbusters, still going 3%. But I think trend growth right at 2% is still enough in the minds of several Fed officials for the Fed to go to 3%.
Yeah, I mean, we have to keep unnerving investors.
Right, exactly. They don't like the fact that the Fed is focusing on the data, which still seem to fit with that idea that they have a few more to go. And also, we're 8 or 9 months from the whole discourse being about overheating, right? I mean, so in other words, the market in the moment doesn't always get it right in terms of how the economy is going to unfold. But Jeff, I'm wondering if it's not an economic issue, are you seeing anything through the capital markets lens at your firm where, besides stocks being down a bit, there's any disruptions or anything like that?
No, we're not. I mean, people are preparing to do what they need to do in order to execute. And I also want to be really clear about this. I think we're in a different spot than what most of us are used to in seeing markets. So I've been on this big kick where I've said, I think we need to measure time in terms of experience, not in terms of increment. So when we see moves like this, think about the amount of data that people are processing on a microsecond basis. Moves like this that now appear to happen in a day or would have played out over months or quarters in prior cycles. So we see a move like this where like it's violent, but I look at this and say there's just a lot of data that are being processed and the markets have a chance to readdress or reset much more quickly. And so that also means they have the ability to rebound quickly once the data begins to read differently.
How are your clients feeling, Jeff? Do you think they've had that moment of fear has peaked or can things still get worse?
This has been very orderly. So I don't think that we've seen the fear factor, but I will tell you, if you look at hedge funds have gotten smoked in the last, 6 weeks. I think they were really offsides for the most part. A lot of them were in this market. So we at Cowen have been very cautious. I will just say we've played it very, very close to the vest. We've taken as much beta out of our exposures as we possibly can on our balance sheet. And certainly with our businesses, we're doing things to make sure that we're not so dependent on market directionality. But that's just, I think, long-term good business building. And so, we're not seeing massive panic.
If the Fed does really take a pause or signal that it's moderating its policy, will the market rally because that's what it wants, or will it worry about Fed independence in light of what President Trump continues to say?
Yeah, I am. So in the short term, it might rally, but I would say if the Fed is viewed to be anything other than independent on this, and they seem to be bowing to the pressure of the president, then I think you have a much more fundamental long-term problem, because people will simply investors will look to the president for making those calls, and that's just a different place to be.
I think the market is solving its problem. Take a look at the 10-year, 306 now. Weren't we at like 306 when all this began? So I think it's pretty interesting here. If the market had a problem with interest rates, it is solving the interest rate problem for itself here. It's hard to argue that at these rates, there's some dramatic impact now on corporate earnings. Now, maybe the Fed raises short-term rates, but the market is not charging them on the long end.
Yeah, although we could look at LIBOR and other ones as well. Steve, we'll have to leave it there. Steve and Jeff, thank you both very much for joining us. Great discussion. To the come, trade is re-emerging as the top fear for members of the CNBC Global CFO Council. The details of that coming up on Closing Bell. Well, Grant, the momentum trade seems to be over as the tech wreck continues. Two portfolio managers join us with where they're finding opportunities in the tech space. That's coming up next on the Closing Bell.
Tech stocks slammed again today as the Nasdaq plunges deeper into correction territory. The FANG names plus Apple have now lost just under $1 trillion in market cap from their most recent highs. Joining us now to discuss more on this tech wreck is Chris Johnson from Johnson Research Group and Quint Tatro from Jewel Financial. Quint, are you buying in the middle of the tech wreck any of these names?
No, absolutely not. I think that's actually very, very dangerous. And one of the things that we're asked all the time is, when will this be over? And I'm looking at it more from a psychological standpoint. When people keep looking for a bottom, I think it's way too early. What I'm waiting patiently for is for people to throw these things in at any price whatsoever, real capitulation, and then we might take a look.
Chris, have the fundamentals got that much worse for some of these companies?
No, they've not. I mean, if you look at the last quarter's earnings report, we had a great quarter of earnings. Typically, you're going to see some sell the news off of the tail of that earnings report. The problem is, and Quint nailed it, I think he's looking over my shoulder, my playbook as well. You've got too much optimism in this market. Investors are looking for too much of an opportunity to buy. When you look at the VXN, the VIX, all these fear indices, they're well off of their February and March highs, which tells me that the market, we talk about the wall of worry, and stocks climb a wall of worry, and those are great rallies. We're sliding down a slope of hope here. And as Quinn said, I'm just looking for everybody to be running for the streets and kind of have that moment, that panic moment. I think Jeff nailed it. This is too orderly, this decline right now. I'm waiting for a little bit of chaos here before we start buying.
Quinn, I don't, necessarily disagree with those sentiments. If we're looking for that kind of moment when it's really going to crystallize that people have given up hope, but we don't necessarily always get that before the market stabilizes, do we? I mean, the market is down just 10% off a high. It's at levels we've been at not that long ago, higher than we were in February. Would you actually expect by now there to be more sheer panic out there?
Yeah, I would, for sure. But that speaks to the complexity complacency. That's really what has me, and it seems like a common theme on this segment, very concerned, is I think we're oversold. Right here and now, we're oversold, and we probably see a bounce. It's going to be very seasonal. But I do believe that that's going to trap even more longs and people who are trying to buy into these things that are oversold. And ultimately, I think these go a lot lower. It has been ages since we've had a real, and I mean a real healthy correction where stocks get cheap. Not, cheap in relative to or relation to some other comparable or some other high-tech flying stock. I mean really cheap. And I think we have a long way to go until that happens.
Chris, just quickly, seasonality can sometimes be a boost into the end of the year. Can that save the tech stocks this year?
Right now, the trends are saying no. When you look at the channels, we're headed down lower. As Quinn said, I hate to be copying or saying the same thing, but people are going to sell into any strength that we see here. There are a few stocks out there that I think are going to see some seasonal strength. They're the older tech. Forget about the FANG. Look at your Microsoft, your Cisco's. And remember, they pay dividends as well. So even with the interest rates kind of being wishy-washy here, I think old tech's going to be something that you want to look at before you start looking at the FANG stocks. Don't try to catch a falling knife on those. You lose an arm.
Chris and Quinn, thank you both very much for joining us.
Thank you.
Right, recession fears are weighing on the market today, but a new survey revealing that's not the top business concern of CFOs. We'll tell you what is next.
Up next, we will reveal the biggest fear facing Wall Street CFOs right now.
A survey of CNBC's Global CFO Council revealing their top concerns right now in doing business. Jackie DeAngelis joins us with the findings. Jackie.
Hey, Sarah. Well, the top external risk factor, according to the CFOs that we surveyed, was U.S. trade policy. 35% said it's their main concern this quarter, when last quarter, 45% were worried about consumer demand. Almost 75% said the impact of the policies are expected to be negative on their businesses going forward. Interesting, though, when they were asked what Congress's top priority should be in 2019, almost half said infrastructure spending, while only a quarter said it should actually be the trade agreements. Meantime, on the Fed, about 60% said they see a rate hike coming in December. For next year, almost half said 2 hikes. A little more than 40% said 3. Meantime, on the stock market, a notable shift here. More than half said they think the Dow will fall back below 23,000. Last quarter, the majority were unsure. The quarter before that, they thought the Dow would surpass 27,000 for the first time. So some of the confidence here certainly eroding. On treasuries, nearly all the CFOs think the 10-year yield will be over 3% at the end of the year. The majority think that range will be 3 to 3.25%. So rising rates, falling stocks, and trade policies keeping the CFOs up at night, guys.
Jackie, thank you very much for that. We'll certainly be keeping an eye on oil markets again after a big sell-off today. That does it. The closing bell.
Thanks, Mike.
All right.
See you guys tomorrow. Fast Money starts right now. Fast Money starts right now, live from the NASDAQ market site overlooking New York City's Times Square. I'm Melissa Lee. Your traders on the desk are Pete Najarian, Tim Seymour, Dan Nathan, and Guy Adami. Tonight on Fast, a sea of red on Wall Street as the market heads back to the October lows. But which names can survive the sell-off? The top technician tells us that 2 names, he says, are a screaming buy right now. Plus, Morgan Stanley's Mike Wilson out with a warning. Do not buy this dip. He will be here to explain why it's time for the bulls to take a back seat. We start off with the market sell-off. The Dow sinking more than 600 points at the lows of the day, closing down about 550 points. For those keeping score at home, that's nearly 1,000 points in 2 days. And the bears certainly on the attack. The Dow and S&P 500 erasing their gains for 2018, now both in negative territory. The S&P firmly in correction, with nearly half the stocks in the index sitting in a bear market. The Nasdaq plunging from its highs, down a whopping 15% from the peak. So with seemingly no catalyst in sight as we head into the end of the year, is the market heading straight into bear country, which would be another 10% down from here. Pete, what do you say?
Well, you know, I think it'll approach those levels. I mean, Steve Grasso was on with you today at Power Lunch. I thought he was fantastic with the charts that he had up there, and he was talking about different levels. And he talked about earlier this year, October, but also going back to that January, February drop that we had. So can we test those or maybe even break through those? I think absolutely we can at least test those levels. So yes, but the one thing that is interesting to me, and I know Dan watches just like I do, we look at the VIX all the time, right? I do, and I think it's more meaningful than I think sometimes we've discussed than you do. But the fact that when we've gone up recently, Mel, and we've had multiple 500 down days now.
Yeah.
So under those circumstances, I'm shocked that we're looking at a VIX that's trading at 22, 23. I just find that unbelievable. The reason I do is, given the movement, it's low, but given the intraday movement, it's extremely low. Because if you look at today, we were down 550, rallied all the way back to, I think we should be approaching 30. Well, and by the time we get there, by the time we get there, I think then we'll finally see the whoosh down effect that we haven't seen yet. Yes.
I just, if you think about the long-term average on the VIX over the last 20 years, it's actually closer to 18, 19. So if you think about where markets have been, this cuts to where we talk about the central bank put. That's basically pulled all the volatility out of the markets. You take central banks out of the liquidity game and, in fact, put them into a place where they're tightening, and you should be elevated. And as Pete pointed out, like the S&P has been down 23, I think, of 29 days ultimately. And we've been 23 of 29 days below the 200 days. So this is a dynamic here where if you look at markets, that should be telling you a character change. And yes, I think volatility is higher.
Yeah, I would just mention that, you can focus on the VIX if you want. You could also look at other risk assets that are moving around a whole heck of a lot. I thought Bitcoin, but I know we're going to talk about it later. I thought its total collapse this week was showing that it is very correlated to risk assets here. That was one of the bull features of Bitcoin. Cannabis. Yeah. I mean, crude oil, yeah. I think that gap today at the lows after the month that it's had was pretty nasty. So when you start to see risk assets correlate like that, especially to the downside, that's reminiscent of what we felt in the summer of 2015, the fall of 2016, those sorts of periods where we had a lot of volatility. So, to me, I just don't know what the catalysts are. Like you just said, Val, I think the Fed could be turning into a kind of reverse catalyst no matter what they do in a few weeks.
Kramer was saying one and done is what Jerome Powell could say, which could be a catalyst for the Fed. And I would also posit President Trump could say, we've got a deal when it comes to China. But those two sorts of catalysts, we don't know if they're going to come. We don't know if they would ever happen.
And my pushback to the Fed would be, I'm not necessarily sure over the longer term that is particularly bullish. I think for a day or two, that language would be bullish, and I think the market would say, well, wait a second. The Fed's not moving for a reason. What's really behind the door? Then I think the market would go lower. In terms of President Trump and the Chinese, I've said this for a while, and I do believe it. I think everybody thinks when President Trump is ready to make a deal, there's a deal to be made. I don't necessarily agree with that. And by the way, each day our market goes lower, it gives more leverage to the Chinese, in my opinion. In terms of the broader market, I've been in the 25-30 camp in terms of the S&P. It's about, give or take, 100 so S&P points away, which quite frankly isn't that big of a deal in a broader context. And I'll say this as well in terms of stocks. We've been doing the show for a long time. People come on and say, if Apple were to pull back 20-25%, that would be the buying opportunity of a lifetime. If Facebook were to have one of these moves lower, and now here we are in the midst of this.
Let's be clear. I mean,
100%.
Apple for the last 3 weeks is the reason why markets are doing what they're not the reason, but again, you have that 25% pullback in Apple, peak to trough today, in about 30 sessions, which is extraordinary.
And the story has changed, right?
Has the story changed? The story might have changed, but Dan's going to yell at me, which is fine.
Sure. What's new?
But the story in Apple might have changed.
What's great?
It's better.
It's not just one stock. It's the story changed in 3 of those. There were fundamental reasons you could put your finger on why they started selling off at peak valuations. Listen, guys, I mean, it's not really that hard, right? All the gains in the entire U.S. stock market were in 5 stocks, and they all started going down together at the exact same time.
Today, just as an example, though, do you think today, given the fact that you looked at Amazon, right? And Amazon at one point in time really got slammed. Early in the day, it was down 100 points, right? It rallied back, actually got into positive territory. Yeah, a couple of different names actually did the same thing. Apple was not one of them. Apple got off its lows, never got into green again. Do you think there was enough volume that there was any capitulation at all in some of those names? Because when you're starting to see very close to double what the normal volume is, starts to make you feel a little bit better that maybe we're starting to scratch that. I'd like to see another day of that because it's just one sample set of today, but maybe tomorrow and or next week we see some of that.
I think the greatest fears in the market should actually be focused on credit. I think we did a good job on this yesterday and not patting ourselves on the back. I'm saying equity investors need to understand that usually the credit guys are well ahead of them. And what we're starting to see is you've got high yield at 30.
Let's go over to this conference call, guys. And
indiscriminate selling was actually better today.
See what they got to say as far as Gap's earnings. Where is Spectra Energy? Oh, I just saw Gap. Where's Gap?
A new brand president at Gap, Neil Fisk. Stabilizing the business has been his first priority. As you would expect, he's assessed the business, the organization, and the underlying processes, and is well into developing his plans. Over the last several weeks, we've landed additional key leaders with impressive credentials, including, and I'm very excited about this, Pam Wallach from Children's Place to lead North American Specialty. This is a role similar to the one that she previously held when she was working directly for me when I was running the brand in 2012. I'm pleased with the progress that Neil is making. Importantly, the actions we're taking are the foundation for improved margin, expense reduction, and the increased profitability that is required for the brand to be a contributor to shareholder value. Okay, all that said, the biggest challenge with Gap brand is largely a function of certain legacy elements, which we understand and recognize, of the brand. A big one specifically is the real estate obligations that currently encumber the business. To be clear, the average of Gap doesn't tell the story. And I want to tease the brand apart for a minute and talk about the parts. We think of it as 3 interrelated pieces on which we can.
Yeah, guys. So is JCPenney still a good stock to buy, especially at this time of year? Again, they just had their earnings too, so we got to get you in our room, Brother Marcel. I don't know if you're still on. If you're not, we have a Facebook Messenger group as well. You can get either over Garfield or Sister Monica, and we can get you in there as well. Again, definitely, get you some nice little, insight to help you out a little bit. Hey, what's going on, family? Todd, Tate, good to see you, family. Good to see you. All right.
specialty stores globally.
Yeah, man. And we got some after hour movement too. After hour, the SPY is still selling off a little bit. You know,
but importantly,
the SPY is still pulling back a little bit here after hours as well, guys.
Is extremely broad.
Matter of fact, let's go to
represent over $100 million of earnings contribution opportunity.
You can see what I'm talking about here after hours.
Portion of the fleet that is dragging down the brand. This is a piece of the business that we are firmly committed to addressing with urgency. It includes
they're talking about addressing
stores
something
around the world that we're evaluating with an objective eye on which ones provide sufficient value to keep. Collectively, the flags have meaningful negative contribution. Beyond that, there are hundreds of other stores that likely don't fit our vision for the future of Gap brand specialty store, whether in terms of profitability, customer experience, traffic trends, importantly, the ride structure, and or near and long-term relevance to the brand. These stores are a drag on the health and a drag on the performance of the brand.
The market is still dropping after hours.
At the same time, we know that stores are an important part of the customer journey.
Wow.
And importantly, we have a significant number of specialty and
why you got this month of December 18th? They got this thing all wrong.
Lead their lives, that have attractive four-wall economics, that operate at brand standards, that have positive trajectory and long-term.
They messed up the thing, glitching, everything glitching tonight. Market
will focus on
getting beat up so much that the thing won't even update.
You have my commitment that while this type of strategic action on the fleet is
on
overdue, I am going to take the action to get this one done and get this one behind us.
He over there begging.
To exit many of these stores, which we will attempt to minimize with appropriate sequencing.
Oh wow, yeah, it's still selling off after hours. Yep. Here we go.
Quickly.
Market's still selling off after hours, guys.
But aggressively.
Again, close, roughly around, 260, 263.85, or basically we say 263. Now we're already down to 267.
Gap brand first.
Right, 263.
Again, look at my words.
75 basically, or 70, 263.70,
which is working and working well. Old Navy continued its profitable sales trajectory in Q3 with 11% sales growth and 4 comp, despite warmer than anticipated weather for much of the quarter.
Oh, I don't have it.
Even with weather challenges, nearly all divisions inside the brand positive comped in the quarter, and product margins continued to expand, which has been true all year, demonstrating the broad-based product acceptance in the box. In women's dresses and woven tops, we saw some softness. It was driven by fabrication and some of the choices of print. The team recognized it, the team got on it, and has largely corrected this for Q4 and going forward. Building on strong and consistent product acceptance, store traffic at Old Navy continued to outpace industry trends, and online saw a meaningful acceleration in Q3, building momentum as we head into holiday. I and we continue to be pleased with Old Navy's consistency and consistently positive results, the clear positioning, the connection with customers, and the operational discipline. Let me turn to Athleta. It remains a growth engine in the portfolio. During the third quarter, 95% of the Athleta business comped positively, demonstrating the underlying health of the business. Last quarter, I mentioned that the girls' business was going to come out and seriously play in the back-to-school space, and it did not disappoint with an over 60 comp in that business. The brand continues to see solid growth in its customer file, specifically new customers, and is on track to exceed its 2018 customer acquisition goals. While we're on the subject of active, I also wanted to briefly mention the launch of the Hill City brand in October. It is very early days, so I won't spend a great deal of time on the call about the brand, but the $22 billion performance lifestyle space is growing and is a key pillar of our balanced growth strategy. We saw white space opportunities for men's premium performance active brand and paired that opportunity with our operating platform, our size, our scale, and our talent. Early product feedback has been positive, customer engagement has been very strong, and we're taking advantage of the millions of visitors coming to our e-commerce platform to expose the brand to new eyeballs. We brought Hill City to life in a little over a year with a team of less than 20, something that would simply not be possible without the advantage of the underlying Gap Inc. platform and customer base. To round out the portfolio, Banana Republic just delivered its 4th consecutive quarter of positive comp, all while continuing to expand gross margin. I want to elaborate a little bit because I believe that the Banana Republic story is in fact quite relevant to Gap. There are absolutely parts of Banana Republic revitalization story that we are replicating at Gap brand. We brought Mark Breitbart back 18 months ago to lead the brand, and similar to Neil, his early priorities were to stabilize the business and assess the talent. Early on, he made a series of leadership changes in the brand across design, merchandising, and marketing. He leveraged the best people, processes, and tools from across the company as a shortcut to bring the brand back to health. That effort includes everything from the full adoption of Old Navy's product to market process to integrating Athleta's fabric technology and innovation into ready-to-wear BR product, as well as instilling operational excellence from other processes that we have built inside the company. Changes required at Banana were not easy, but we are now seeing wins in our product and in the customer experience that give us confidence in the ability of BR to deliver improved profitability and contribute meaningful to the Gap Inc. portfolio. Before Terry takes us through the financials, I want to take a moment to describe 2 critically important priorities for me as the leader of Gap Inc. First, within the company, we are continuing to build aggressively a culture of accountability. I take this very seriously, and I know Terry takes this very seriously as well. A good example is our performance this year. We saw that we continue to be committed to delivering results within our original guidance range. Clearly, the year hasn't come together in quite the form that Terry and I expected it to or wanted it to, but we remain committed to responsibly delivering on the commitments that we have made to you. Second, consistent with this effort, we are focused on driving shareholder value. We believe firmly in the size and scale advantage of the Gap Inc. platform, our strong and loyal customer base, and our iconic brands. But as I have said previously, many times, each brand must earn its place. This year, our earnings are coming from our healthy brands and our expense discipline. We are focused on margin and profitability improvement, not necessarily growth at Gap brand, and we will take the necessary actions to bring the brand to a profitable core that unlocks shareholder value and forms the basis on which to evaluate its long-term place in our portfolio. With that, let me turn it over to Terry to walk us through the financials for the quarter.
Thanks, Art, and good afternoon, everyone. As Art said, although weakness at Gap brand pressured our results in Q3, we do remain encouraged by the results throughout the rest of the portfolio, including Old Navy's continued momentum, an acceleration in trends at Banana Republic, another strong quarter delivered by Athleta, and the underlying expense discipline we've demonstrated. Turning specifically to the third quarter performance, just as a reminder, our reported results include the impacts from the adoption of the new revenue recognition standards, which changed the classification of certain line items in our P&L. For the third quarter, the presentation changes resulted in an increase of $170 million to net sales, an increase of $128 million to gross margin, and a $128 million increase in operating expenses. To be helpful, we've included a slide in our quarterly earnings presentation that details Q3 2018 results with and without these significant presentation changes from adoption that can be found in the investor section of gapinc.com. So let me run through the results, starting with sales. Net sales for the quarter were $4.1 billion. This represents growth of about 2% over Q3 2017, excluding the presentation changes from the adoption of the new Rev Rec standards. Comp sales were flat compared with positive 3% last year. Again, excluding the presentation changes from Rev Rec, spread for the quarter was largely driven by new store openings. At the brand level, Old Navy had another strong quarter delivering a positive 4 comp and 11% sales growth. This double-digit sales growth includes 54 new stores year to date, demonstrating strength in our runway for growth. Despite weather variability throughout the quarter, the brand continued its strong track record, delivering another market share gaining quarter across all divisions. At Gap, comp sales were down 7% against positive 1 last year, driven by the assortment architecture issues that Art discussed. It's worth noting that at Gap brand, we did see an improvement in comp trend as we moved through the quarter, and the initial reads following the new holiday flow have been in line with our expectations. Banana Republic posted its 4th consecutive quarter of positive comps with a +2 comp against last year's -1. As Art mentioned, we were pleased to see continued expansion in gross margin as the brand focuses on driving consistency, increasing productivity, and reducing the breadth and depth of promotion across the assortment. We're encouraged by the positive customer response as we head into holiday. Athleta delivered another impressive quarter with broad-based category strength. The team remains laser-focused on growing market share by continuing to provide innovative product designs and a compelling customer experience. Momentum in online also continues, delivering solid double-digit growth, with all brands contributing positively. We continue to focus on providing a seamless shopping experience that offers convenient capabilities on our industry-leading platform. We remain confident in our goal to reach over $3.5 billion in online sales this year. Moving to gross margin. On a reported basis, gross margin was 39.7%. $128 million, or about 160 basis points of expansion, was driven by the presentation changes from revenue recognition adoption. Excluding that impact, third quarter gross margin declined 160 basis points, driven by a merch margin decline of 180 basis points, partially offset by 20 basis points of rent and occupancy leverage. There are some countervailing elements to the merch margin trend, so let me walk you through the components. The underlying product margin is down about 30 basis points, driven by the Gap brand, which more than offset expansion at Old Navy and Banana Republic. This reflects the continued challenges in the business, but as we expected, shows sequential progress for the Gap brand. As Art mentioned, given improvements in our tops to bottoms ratio, along with additional color and brand appropriate product throughout the assortment, we continue to expect sequential improvement in Gap's margin trend in Q4. The remainder of the merchandise margin deleverage was largely due to increased shipping expense. As we mentioned last quarter, we started up our Fishkill DC with significant new automation. As we fully operationalized the new equipment and technology, we experienced pressures from increased splits for our online business, meaning more packages and higher shipping costs. This largely affected Old Navy, given their strong online performance in the third quarter and the brand's high UPT. Going forward, we would expect the Fishkill impacts to moderate, although we will continue to have opportunities to optimize our shipping costs. Rent and occupancy leverage was primarily driven by the sales growth. Moving to SG&A. On a reported basis, third quarter total operating expenses were $1.3 billion. The presentation changes from RevRec resulted in a $128 million increase in operating expenses and accounted for 190 basis points of operating expense deleverage. Excluding that impact, third quarter SG&A as a percentage of sales leveraged 100 basis points, exceeding our previous guidance. We continue to make nice progress against our productivity initiative with expense discipline, particularly around discretionary and controllable expense, with bonus favorability also helping to drive leverage in the quarter. As I mentioned last quarter, internally, we set a goal for the organization to identify and action $200 million in productivity savings. We remain on track to exceed that goal for the year. As I've discussed since initially introducing our productivity initiative, I'm really pleased with the organization's adoption of this work, supporting both near-term results while building a simpler, faster, more efficient organization over time. Moving to taxes, our third quarter effective rate was 24%. This lower rate reflects a reduction in our fiscal year 17 TCJA transition tax liability due to recently released IRS guidance and finalization of calculations for our federal tax return. With better visibility to the adjustments to these provisional estimates for TCJA, we now expect our full year effective tax rate to be about 25%. We'll continue to analyze our tax return positions under TCJA as guidance is released, and we'll finalize our provisional estimates in Q4. For completeness, I do have to remind you that adjustments to these provisional amounts for additional guidance, technical corrections, or new legislation could materially impact our Q4 and annual tax rate. For earnings, our third quarter earnings per share were 69 cents, including about 3 cents of benefit from the lower tax rate versus our expectations, compared to earnings per share of 58 cents last year. FX was a benefit of about 1 penny for the quarter and 3 cents year to date. Given the strengthening of the U.S. dollar, we now expect a 4-cent benefit from FX for the year versus our original guidance of 7 cents benefit. Regarding cash flow, our year-to-date cash flow was $57 million compared with $197 million last year, which included $60 million of insurance proceeds related to property and equipment. Lower free cash flow year over year was driven by an increase in capital spending and a lower bonus accrual in 2018. We ended the quarter with $1.3 billion of cash equivalents, and short-term investments. With regard to the earnings outlook for the remainder of the year, as you know, the volume and impact of the fourth quarter is substantial, and our performance in the quarter is important to our delivery of the year. While challenges at Gap brand have continued to impact our performance beyond our original expectations, the underlying fundamentals of the other brands remain strong, and we've been able to leverage our portfolio consistent with our strategic priorities to deliver the first 3 quarters of the year, largely in line with our expectations. Given this, along with the benefit from a lower tax rate, offset by FX, we are narrowing our full year earnings per share guidance to be in the range of $2.55 to $2.60. As a reminder, our annual guidance range includes the negative impact from the loss of the 53rd week of about 6 cents. Just as the first quarter benefited from the calendar shift, the fourth quarter is expected to be negatively impacted both from the shift in the calendar and the loss of the 53rd week. We continue to expect the spread between comp and total sales in the fourth quarter to be negative. Additionally, given the impact of having 1 less week in the fourth quarter and the calendar shift, we expect deleverage in rent and occupancy in the fourth quarter. We continue to expect meaningful expense leverage in the fourth quarter, despite headwinds from the loss of the 53rd week, as we left some unique incremental spend in the fourth quarter of last year that we do not expect to recur. We continue to expect full year comp sales to be flat to up slightly with a modest positive spread. Given the way the year has unfolded, I thought it might be helpful to have a little more specificity on the expected composition of those Q4 revenues. Based on current projections, we would expect Gap brand to show sequential progress, but still be down for the year. A good estimate is probably closer to the first half trend. We expect Old Navy to continue its strength, building on an amazing 9% comp last year. They're forecasted to deliver sequential progress from Q3 with another double-digit 2-year comp. Banana Republic's strength is expected to continue, also with sequential progress. And finally, we expect the strong athletic trends to continue. Before I end, let me go back to the balance sheet. I realized that I didn't cover inventory and finish off our cash. So starting with cash, we did continue our commitment to returning cash to shareholders by completing an additional $100 million of share repurchases during the quarter. We ended the quarter with 382 million shares outstanding. And year to date, we paid dividends of 281 million and currently have a dividend yield nearly 4%. On the inventory front, we ended the quarter with inventory up 8% compared to the third quarter of 2017. Similar to last quarter, Old Navy, which represents about half of our total inventory, is carrying higher balances to support new growth. Additionally, at the Gap brand, to mitigate some of the lateness we experienced in the first half, we intentionally made the decision to increase the dwell time of inventory in our DCs ahead of the important holiday season. This resulted in a pull forward of receipts and an increase in the brand's ending inventory balance. Together, new store growth and the intentional decision to increase dwell time for Gap brand represent about half of the total inventory increase. The remaining increase positions us well for holiday, and we feel comfortable with the composition of our inventory heading into Q4. Regarding capital and store count, year-to-date capital expenditures were $510 million. We have reduced our expected capital spending for the year to be about $750 million versus our original guidance of $800 million. Year-to-date, we've opened 109 company-operated stores, largely Old Navy and Athleta, while closing 56 stores, primarily Gap and Banana Republic. We ended the quarter with 3,218 company-operated stores. We continue to expect 25 net new stores, but we now expect Old Navy to open about 70 stores versus our previous guidance of about 60, while accelerating the closure of some additional Gap brand stores. The balance sheet finished. Let me close out here. As Art mentioned, we have significant work underway on the Gap brand, both operationally and more strategically, to identify and action the more radical but necessary steps to unlock shareholder value by establishing a healthy core business from which we can profitably grow. We understand the nature of the problem. We have some, but not all of the initiatives in place to get the brand back on stable footing, and we're in process to evaluate all possible options to make the hard decisions and deliver the right results to our shareholders. So with that, we'll open it up for questions.
Thank you. If you'd like to ask a question on today's call, please press *1 on your telephone keypad. Please limit yourself to one question. We'll take our first question from Matthew Boss with JP Morgan. Please go ahead.
Great. On margins, what's the embedded expectation for merchandise margin in the fourth quarter? And I guess larger picture, how best to think about freight and wage pressure relative to this year as we think beyond?
Yeah, so we typically don't guide to that level of specificity, but I know that you're kind of closing in on the end of the year. I can tell you just if you look at the full year, given the trends through the first three quarters, we don't expect to have an expansion of gross margin on the year. We do expect sequential progress, and it really does come down to some of these shipping trends that we talked about, more so than the actual product margin beyond what we've seen in the Gap brand. So that's general guidelines as you think about the remainder of the year and the full year look. Minimum wage, this is one where we tend to be ahead of minimum wage actions. I think it's well over 70% of our employees are paid at market wage today, which means, we're already well ahead of that. We typically have been, it's one of the reasons why we've been investing in automation in the DCs, is it does allow us to drive productivity as an offset to some of those minimum wage pressures. So far, particularly in 2018, we haven't seen a lot of pressure. Same with the transportation. Is that the other part of what you asked?
Well, the freight and the split, I think, was part of that. Yeah, if I go to that on the freight and splits, from an overall just factor standpoint, we're not seeing significant pressure in freight expense. What Terry highlighted, Matt, was that as we brought Fishkill up and we were managing fulfillment direct to consumer from different pools of inventory, we did see what we believe is a relatively momentary thing around package splits because of how we were bringing it up at the end of the day. And we're very much on it. We're very much focused on managing package economics. We've done an excellent job of that over time. And
Great. Good afternoon. Thank you. Terry, just first clarifying the comment you made on the Old Navy comp in Q4. Is your expectation to show sequential improvement relative to the plus 4% reported in Q3, or was that sequential improvement specifically referencing the 2-year stack?
Yeah, well, actually both, but more focused on the sequential improvement over the Q3 4 comp.
Got it. Thank you. And then circling back on your comments on Gap Specialty, the bottom half of the fleet that you mentioned, 350 plus stores, I guess how quickly do you think you can exit those, and what does the comp trajectory look like in the top half of the fleet as it sits today?
Yeah, so let me answer the first question first, which is it's still a mixed comp trajectory, and but the important thing to think about, and I'm giving you proportional numbers, we're still doing the work and we haven't made any decisions to figure out exactly where we're going to go with this. And obviously our landlords are our partners also in moving down this path. The best way to really think about that top half is those are stores that we believe will do today have a four-wall return that allows us to operate them profitably and to continue to reinvest in those stores appropriate to maintain them to brand standards. We have had a lot of stores that are in the bottom half of the fleet that have continued to deteriorate over time, and it is my strong belief that we've kicked the can down the road on this and offered a deteriorating customer experience, and it does have a negative effect on the health of the brand. As to comp trends, we have some of those bad stores that are comping positively, but that could be local circumstances. A lot of them are negative. But the trends overall are more positive in the upper half than they are in the bottom half.
It's helpful. Best of luck over holiday.
Well, let me add one more thing too. Again, because we have at times kind of crossed our fingers and hoped to grow our way out of the problem. As we look to getting Gap brand to a place where it creates shareholder value, we are not building a plan here that is just all of a sudden the little guys going to be a little loud, and we get a profound expansion of the margin, and we grow our way out of the problem at the end of the day. I have my hands, as does Terry, on things that are structurally addressable, that have a set of consequences and a set of outcomes associated with them. Of course, I am always hopeful that as we improve the product and get our marketing in line, et cetera, that we start to get positive lift out of the business. But I believe we owe our customers and our shareholders better as we put a plan together here to address the structural changes that we can make, a lot of which is, again,